Welcome to Trade Live with IG, everybody. It is Friday the 4th of April with myself, Rich McDonald, and the big Ronnie Demo. How are you?
I'm happy to be here. Luckily, I was short on the demo account, so the big demo account is going crazy right now. A lot of I'm gonna.
Mate, do you think that's sensitive to my losses? Do I want to hear about your fantasy league team doing well when I've been ransacked and I've got a broken leg hobbling off the pitch?
You know what? That sounds like a you problem, mate.
Now, do you feel liberated? I certainly feel liberated of my capital gains tax, because thankfully with 2 days left of the tax year, yesterday, I got some nice profits wiped out, so I don't have to pay much capital gains.
Do you have any capital gains to write off, or?
What, from the year before?
Yeah.
No, I wish. So yeah, we've actually got live footage of Ronnie attacking me. Look at that, and there, that's me going down. What was? I don't know who this manager is, but if
Jose Mourinho. You don't know Jose Mourinho?
No, it's obviously Mourinho doing it, but who's the guy that's fallen like a...
It seems like he's Galatasaray's manager, which is the other big team in Istanbul. But yeah, Turkish league, anything can happen, mate.
If your manager is doing that, then like, what are you teaching your players to do? The game is an absolute joke. I think we've seen it enough, guys.
The game's the game, innit?
The game is a game. Don't hate the player, hate the manager. But yes, how was yesterday?
Oh, yesterday was how do I put it? It was intense, to say the least. Yeah. On one hand, back-to-back calls from clients.
Yeah.
Almost had to put my adult diaper on because I couldn't get away from the desk. And on the other hand, my WhatsApp was blowing up because literally everyone I know was texting me about what was going on. Mm-hmm. Even my mom.
So that's three?
All the three people, my mom, my brother, and my sister. And so my mom has put me in charge of her pension savings and placings. Oh. She was texting me and she was saying, "We're good, right? You've taken care of this. We're not losing any money today, right?" I said, "Mom, everyone is losing money today."
That's good way out of it. Good. Right. We fell into the US close. My hedge, unfortunately, was a put ratio. So that means that you go short and then you close the ratio, but then you go long around here. And of course, we went right through the bottom, and I ended up, it should have made me 10x, and it made me 2x. And that was the hedge for Nike being down 14%.
That's rough. But I also feel like 2x is better than minus 2x, mate. I feel like
that's if it dropped another percent, I was in some real trouble. But let's just have a look at some of these.
Armageddon.
Armageddon. Nike down 14. United Airlines, as if you'd expect an airline to be down 15.5%. Citigroup, would you expect a bank to be down 11? I mean, this was COVID's financial crisis kind of moves, you know.
Yeah, the market hasn't been as low as it's been since March 2020. But I agree with you that the names we see up here aren't the first one that I would, come to mind. Yeah, Apple, I understand.
Walmart, Disney down 8.
Walmart, I also understand. I mean, because Walmart, you understand, most of their products and their goods, they come from out of the country.
Yeah, but imported. It's a defensive investment. It's a supermarket that is a staple.
Yes, but the question is, they've already passed on a lot of the cost from the previous inflationary wave. Mm-hmm. Question is now, how much more pricing power does Walmart have to continue to transfer that cost to the consumer?
Absolutely. No, you make a very good point. It's just, I'm talking about as a portfolio manager.
Yeah.
Right? When you're in Walmart for a reason. It's to balance off your position in Nvidia or a Meta. Boom. Nah, not in Trump world.
No mercy.
And then let's have a look at the other stuff, the stuff that I try not to touch. And oh, yeah, I've touched Upstart, down 18% right in my grid, short the $41 puts. So yeah, it was an interesting day, a very interesting day. But we're on to a brand new day today. It's a new start. Let's go.
Are we buying the dip today, Richie?
On today's show? Well, we'll go into that, sir. What's coming up on today's show? We've got a patch show yesterday. Yesterday was a wonderful show. I was buzzing the whole day after speaking to Nick Feingold. We've got, again, why are you telling us what we're doing right now? 8:30, live from the trade desk. Angeline is back with Chris Beecham. So Chris Beecham, of course, our chief market strategist. He will be there to update everybody with his wonderful background of the history books.
Well, one would not expect anything less from a historian.
Yes. Was that a joke? Or are you on?
No, I'm just making a statement.
You not had any caffeine this morning?
No, I was rushed here.
That's true. We'll go through that in a minute. 9 a.m. I'm doing the all sessions opening bell. I'm going to try and get Elliot Harrison for market measures at 9:10. And then Angeline and Aaron Bright take us home. Take me home with Isar joining in injury time at 9:40.
And how much caffeine have you had this morning, Rich?
I had a lovely cup of tea from Pret a Manger, and I walked in, and the usual guy there in South Kensington, and I said, "Happy Friday," and he went, "It's only Thursday, mate." And he genuinely thought it was Thursday, and he had me believing it was Thursday, and that just really confused me.
He's a hard worker. Every day just blend in. It's just another day in the office.
Well, he does 6 days a week, including both weekends. So
there you go.
But on this non-farm Friday, with unemployment to come, normally a big market mover, let's go into overnight action and see how much the repercussions around the world happened. So let's have a quick look where we are in the futures, because while I was walking into Pret a Manger, I saw that Japan was down 3.7%, and I've been waiting to buy Japan for months. In fact, I've been waiting to deploy some pension for months, and I think today is the day.
You know what, Rich? I'm inclined to agree with you. I've been quite bullish on Japan this past year because the economy has been sort of turning the wheels of the engine, and they've been picking up steam, and it's been priced in. But now I feel like with Japan, we're actually getting some value for our bucks, and I think it's a great time to enter. And what we also have to consider is that there are a lot of domestic companies in Japan. When we think of Japanese companies, we think of, you know, the Sonys, the Toshibas, the big exporters, but the economy is shifting more towards domestic consumption as well now.
Yeah.
The companies, and those are standing to benefit from an isolationist America. So
you can see where we bottomed here. So this was down 4% at 6 a.m. this morning. You can see my cheeky little purchase there on the way into Pret, and we're already 300 points higher. Maybe it's going to be a good day, Ronnie.
Well, you know what, Rich? The way it looks like, it's going to be. And you know, a day that starts with you, it's always going to be a good day.
Well, this is the thing. So we were meant to have Mini Cooper in this morning, and poor Luke Cooper's not feeling so well.
To everyone's disappointment, the super sub himself had to step in. I was in the gym. Doing my curls, and
Can't see any curls. You straighten it afterwards.
Biceps curls, if you've ever tried one of those, mate. And Luke was texting me saying, "Mate, are you up?" And I said, "I've been up for 2 hours, brother."
He was just getting home from the nightclub, was he?
Exactly. No, he was feeling a bit ill, so I said, "You know what? The opportunity to be with Rich on a Friday morning, can't pass up on that, mate."
I'm not sure you've been in on a Friday before, have you?
Pretty sure I've been on every day, mate.
Right, so where are we with the S&P? The S&P, we got hammered yesterday. Let's see if we can get a full session. There you go. Whoa, look at that. So that is from, of course, the announcement. And then the market open yesterday is around here. So this was the market open. We managed to get to 6 p.m. European close was here. And then we saw a nice little rally, as sometimes we do post Europe, because those Europeans love to have a little panic into the close. However, they might have been right, because we saw a significant sell-off into the US close, which was here at around 53.90. And this morning we got down as low as 53.44. Now that was my first target. 5,300 is my first target. So I have started to buy some futures on the S&P there as well.
I think that's a very smart move. I picked some more up in the pension yesterday. So did
your mum's pension.
Both, mine and mum's. You know, I think
whose did you do first? You can't do them both at the same time.
Anyhow, so
no, come on. I'm pissy on this. Do you do your client first, or do you do your own one first?
I did mine first.
You front run your own mother.
Luckily, my mom doesn't speak English, so she won't be watching.
We'll translate.
But I just want Mama McDonald to know that I would never do the same to her. If
she doesn't let me touch her pension. Are you mad?
Oh, she's smart enough.
Yeah. I invested. We looked through her stock portfolio 20 years ago, I reckon, and we bought Centrica.
Oh, nice.
At about £3, it went down to 60 pence.
Oh, you bloody hate your mom then.
And can't remember what the other one was, but yeah, it was a lawnman. We had lawnman at about £8 and it went down to £1.
You bought Kodak photography.
So yeah, so I don't get. She's had SSE for about 25 years.
Oh well, gotta represent.
Yeah. Now, why am I sitting here bullish this morning after getting smashed in Nike and Deckers yesterday? Well, it's because we know it's a game, and now we've got proof that it is a game from Trump. Donald Trump floats China tariff relief in exchange for TikTok sale approval. His quote was literally, "We have a situation where TikTok, where China will probably say, we'll approve a deal, but will you do something on tariffs? The tariffs give us great power to negotiate." It's all a game from him.
Mate, I'm not sure what was worse there, your take or your accent.
Great.
I mean, I think
great accent. Great.
Stop, please. There's children watching. I do think that, you know, we always expect Trump to pull this sort of art of the deal thing, right?
Well, so why is everyone falling for it?
Well, because there was two double whammies. There was two double whammies with these tariffs. Mm-hmm. First one was no one expected them to be at the level that they were. People expecting
shock and awe,
10%, maybe mid-teens, something like that. They came up much higher than that, close to double. That was the first whammy.
So that gives them room to negotiate.
Exactly. But here's the double whammy. Everyone's expecting an art of the deal, right? If they say that the tariffs would come into place in 1 month, they would have a good amount of time to, you know, actually negotiate and come up with a deal and play their hardball. But these tariffs are coming in place next week.
You don't give somebody time for hardball. You give them 1 week, they shit themselves, and they come to you begging. You do the deal, and you get the best result. That's it. He's written a book on it.
Well, then it's gotta be true.
It's just, I mean, it gives us opportunities.
Are you expecting that the bureaucracy capital, Brussels, is gonna negotiate a deal in, what, 5 days?
I'm actually not bothered about Europe. I couldn't give a damn what Europe negotiate with them. It's China. China's the one because 54%, and Vietnam. Vietnam have already negotiated something, and that's going to change that tariff down from whatever. I mean, there's so many numbers, I can't remember what it was. But the fact that he's already saying, standing on Air Force One, and he's saying the tariffs give us great power to negotiate, then there's obviously going to be headlines in the next week.
Well, Amazon's already put in a bid together with the OnlyFans founder for TikTok.
Well, this is it. So TikTok looks like it's going to get done this weekend, and it's ByteDance will. Let me see if I've got this one. Sorry, let me. So yeah, we're very close to a deal with a very good group of people. Under the proposal, new outside investors, including. Go on, you say that one. That's a Scandi name.
Which one?
Andreessen.
Andreessen Horowitz.
That's it. Blackstone, Silver Lake. Remember, Silver Lake were the ones involved in AMC.
Yeah.
Did an absolute huge deal in AMC converts. So that is the group that's going to buy half of the US business. And then you've got General Atlantic, Susquehanna, KKR, and they would own 30% of the US entity, while ByteDance would keep a stake at 20%. The only thing still being negotiated.
Go on now. What's the last firm?
The algorithm.
After KKR.
Cotu.
Yeah.
Quatu.
Wish we had Fred here.
Quatu.
I mean, I love Phil, but
I was going to say, producer Phil, you're doing him a disservice here. Right, who have we got in the chat this morning? They are the Friday team. We got Steve Davies, Jesse, good morning to you. Andrew McKelvey, well done, Andrew McKelvey and Curry's. Great shout yesterday. Boise, do we think tariffs will be eased by April the 10th? That's exactly it. I've got a big call structure for April 9th expiry. Maybe April 11th would have been safer. And that's it. Boise's called it. Wants max pain for negotiation. Jugger is happy to hear that your family's all healthy.
Jugger, you are absolutely correct. Family is healthy. Everyone is healthy. So that is true. Health is wealth. And away from the numbers. Thank you. I have considered many times doing stand-up.
You say that, Jugger, right? But I am meant to be on a train to Liverpool for the Grand National in about 25 minutes. And I'm not, because I'm here with you. My good friends, Ulick Burke.
What's bad about that, mate?
Napstar, Mark Knapp, Ulick Burke on that train. Good morning to you, gents. I apologise, Stuart Holt, for not being with you there. But have a great day, guys. I haven't had any alcohol in 7 days, and I strongly intend to.
Outrageous, mate. National crime in Scotland, that.
What, you're about 3 weeks, aren't you?
No, I had a bevy on Wednesday, actually. When I went to Larry's at the National Gallery for a jazz evening.
What? Sorry?
Yeah.
This is a side of you I don't know, Ronnie.
I'm a man of culture, you know. I know a lot of you are, I don't know why you sound surprised, but I'm a man of culture, which I acquired a lot of it up in Aberdeen, drinking Buckfast and Tennent's.
Right, this is actually where you were on Wednesday night, isn't it? In the cinema, seeing Snow White try to help them recover for their 115 million loss. What did you think of the movie?
I haven't seen it. Maybe something for you and your girlfriend. I don't know.
It doesn't sound like it's really doing that well at the box office. 150 million loss. What do Disney do from here? You know, down 8% yesterday.
I mean, that was the sort of, the box office was sort of the saver for Disney last time around. You remember they dropped subscriptions on Disney Plus. They had a massive churn there. They have a lot of restructuring costs, but it was sort of overcovered by the massive box office results from Moana. So now we're seeing these supposed to be a big hitter, but apparently not. And I think this is going to have a long-term effect when we see the earnings come out. But I just have one question for you, Rich, before we move on.
Please.
If we see some sort of deals come out, say, I mean, Monday, beginning of next week, Monday, Tuesday, we see some sort of deals start coming out, announcing with Southeast Asia, China, Europe, Vietnam.
Europe will take longer.
Southeast Asia, I'm guessing that would be included. Vietnam would be included in that. But would that be a catalyst for, you know, for a big market comeback? Is that something you believe in? Is that what we're sort of hoping
yesterday
for?
was a fire sale.
It was.
Right, an absolute fire sale. Can we go lower? Of course we can.
How low can you go, mate? Limbo champion.
51.50. We can go to 51.50.
I mean, what's actually more concerning about this is that the sort of the GDP effect of this. So Goldman Sachs are predicting that these tariffs, based on the assumptions that they're not sort of counteracted by their counterparts. So if Europe or China doesn't come with counter tariffs, based on that assumption that it remains like this, we'll see a GDP slowdown of 1 to 2%, which would translate into an earnings slowdown of 5 to 7%.
Yeah, a slowdown, meaning that not negative. A slowdown from so GDP estimates were 2.7.
Yeah.
Right. They're talking about you coming down to 1% GDP growth, right?
Yes.
That is a stall.
Which would, but here's the kicker. They're predicting that would translate to a 5 to 7% drawback in earnings.
And where are they for earnings? They've just come from up 12 to up 7. So you're taking back to flat earnings growth for the year.
And here's the kicker. Low expectations means easier to surprise positively, right?
Yeah.
So I think I don't want to be a mega bull, which I usually am, but I do think that with the lower expectations now, with the expected decreased earnings, I think the upside is much, much bigger compared to the downside. And we see we've sort of taken the froth off from these overpriced companies. And now we're coming down to levels that they're making these companies quite attractive. They're trading at the PE, forward PE ratio that we haven't seen in about 6-7 years for the Mag 7.
Yeah, but the E is wrong. That's Goldman's whole point. The E is completely wrong. What is priced in at the moment in earnings estimates is 10% growth this year and 10% growth next year, right?
Right, but if we
bring that E down, then the estimates that we're told, Google on 16.5, it's not.
No, but yeah, but now we're going to come down to more rational levels.
Yeah, but the PE has to go up then. So, right, at the moment, the market here and now is on about 20.5 times expected earnings.
Right.
If you go along with Goldman Sachs, then the market's on 22 times earnings.
So you're saying that we're now coming to a normalized level rather than a discount level?
Well, we're coming to the right level. Don't believe any PE that Yahoo Finance is telling you right now, because the E is way too high.
That is very true as well.
So the price has come down, the E stayed here, so the multiple looks attractive, right?
You're correct.
As soon as the E comes to a real level of what we'll get, then, all right, Nvidia's not on 24 times earnings.
That's what I mean. We're coming down to normalized levels. We're not going to be at these crazy...
But it's not. That's what I'm saying. Nvidia's still on 30 times earnings. It's just you haven't had the earnings downgrade yet.
Yeah, but now it's going to come down to, say, 24, which is more rational than 30.
No, the E is wrong. Once actual analysts go through and people profit warn, I'm not saying Nvidia is going to profit warn. Once Nike profit warn, once Walmart profit warn,
right,
then the E comes down. So that means the multiple goes up. So the multiple is not real at 24 times earnings. The real multiple is 28 times earnings.
I see your point, Rich.
That's why people are buying into something that's not real, because now they're starting to cut earnings, right?
Correct.
So everybody brings their estimate for the S&P 500 lower and lower and lower. That's why we could potentially hit 51.50. I agree with that. I had a really good message from a guy who's been in the market for 38 years yesterday. Let me just see where and he was talking about the 50-day moving average on, sorry, where is this thing? My apologies, everybody. Right, let me find this over the break, and I shall go through it. There we go. Right, key levels to watch on the S&P are the 100-week moving average at 5150. Then there's, of course, the 5,000 level because the market loves a round number. And then the 200-week moving average sits down at 4,700, right? So these are not day averages. These are 100-week average, 200-week average. So 5,150, 5,000 and 4,700 are the big numbers. As I say, today I am starting to move my pension back out of cash into the market because it's the art of the deal.
That is something I agree with you on.
At what point does the demo account close the short?
You know what? The demo account might have done its work, and we might jump in with the big dogs.
Really? On that bombshell, we'll see you in 2 minutes for the upgrades, downgrades, the economics for the day, including that non-farm payroll, and your guides, because Elliot has done it again. BP chairman gone. We'll see you after the break. Welcome back for this opening bell on the day after the meltdown, let's call it. We've got some one comment in the chat jumped out to me, and that was, Ronnie, you should be doing stand-up.
Thank you. I've considered that many times, actually.
Standing up and walking out of here, I think is what he meant.
That's why he told me to do stand-up and not you, mate.
R6Sena hiding in the S&P equal weight. That has been a wonderful trade. Until yesterday, the S&P equal weight was about flat for the year, with, of course, the main index being down 6 or 7, now down, what even is it now? 11?
I don't want to know. But it is a smart hedge, defensive buy.
Go on, grab your bell there, Ronnie. Right, what is BP's reaction going to be to the search for a new chairman? He's giving it a good go there. The team are happy with you in the gallery. That was an impressive bell ringing.
Well, I'm happy with the team, so it's very mutual, the love.
Right, so on this Friday, let's see where we're going to open up. HSBC down 2% right from the off.
Oh, they've been getting murdered these days, haven't they?
Burberry falling down 90 basis points. IHG, no let up here. The FTSE was flat on the futures, but some of these moves, NatWest getting it again down 2.5. Barclays. Oh, Barclays.
Canal Plus.
So we...
BAT, the defensive. You know what? In times of stress, you're going to be smoking, mate. What do you do when you're stressed? Smoke. Smoke and coffee.
You chew gum and stuff, don't you? That's
I do, but that's because
weird
I'm
stuff.
Swedish. But they also own that company too.
Oh, Swedish Match.
Yeah,
Did they?
yeah, they bought them.
Right, come on, let's get focused.
right.
Lloyd's back down to 68. Look how much these banks got absolutely murdered yesterday. Shell down 1.2, Reckitt's lower. I cannot believe Glencore is 255.
That is an attractive price for Glencore, mate. HSBC was getting murdered yesterday. Antofagasta. Watches of Switzerland is up, surprisingly. A luxury watchmaker is up.
Right, BP down 75 basis points on their chairman resigning. Elliott have done it again. They've got in there. Murray Auchincloss still at the helm as CEO, but BP looking for a new chairman. Are you available, Ronnie? Diageo up another 1%. Drop back from that. We managed to sell those yesterday at £21. They dropped back down to £20.40, but regaining some yesterday. As Ronnie says, bats smoking. After Go Next dividend a few weeks ago, they've regained all of that.
Which I don't support. I don't support smoking. Let the record show.
Yeah, but you report the big yields that it throws off the cash.
Oh yeah.
Severn Trent, that's it. So money going back into these. Looks like the algos are attacking the same names as they attacked yesterday, and they are buying these defensives again.
Buying defensive. I don't classify these companies as defensive.
Of course they are. What's Bats is the most defensive
Okay,
thing you can get.
BAT, yes, absolutely.
And
but
Severn Trent.
Watches of Switzerland, luxury watchmakers, that's defensive.
That's just a small stock. Don't even look at that one. Look at the.
What about Burberry, Marks and Spencer?
No, fair. You're right. You are right on Burberry. Marks and Spencer's is definitely. It's where you buy your underpants and your bread and milk from. Of course, it's
that's
defensive.
little, mate.
National Grid, defensive.
Yep.
ABF, Primark, defensive. Unilever, defensive. The algos are coming in for the defensives and they're killing my mining stocks once again, and the banks. Standard Charter, Asian exposure down 3. No let up for these at all.
Anglo keep getting piled down. Barclays as well. All of these had pretty rough days yesterday, but I'm not sure this is.
I've been waiting to buy Barclays for a.
I don't think these sort of murder prices are justified on these companies. Oh, go on then, do it.
Yeah, look at this. This is new. Right, when did we last? Mind you, Barclays has had a massive run. That is one thing. Let's have a look at the daily chart for Barclays. Yeah, see that's not quite as. Mind you, will there be support there?
Let the viewers at home know that the gallery is shouting in there saying
not yet. Yeah, not yet. That's right.
So maybe they can let us know in the comments if they agree with the gallery or with you. Let's do a poll.
Let's do a poll on
Should Rich buy Barclays or not?
Yeah, okay, let's do that. What do we think of Barclays here? This is not financial advice. This is pure entertainment.
This is how everyone should make their financial decisions. Let group and peer pressure affect you.
A community group. Do we think Barclays is interesting? Well, I don't know if you can go down with the wording. Take that down, Phil. We'll find a better way of phrasing that. Yeah, look, this is some real. Right, let's have a look in Europe and see what there are. So
in Europe, we see the same sort of similar. We see the banks getting hit as well, but interestingly enough, the defensive names here: Schneider Electric. What else? What do we have any defensive names up here?
On the upside,
Yeah,
Rheinmetall.
Rheinmetall. Puma is up after their new CEO change.
Danone. Actually, shall we take a quick look at upgrades, downgrades? Let's see.
But look at this. LVMH Porsche up. That's not defensive, mate.
Wait 1 second. ASML upgraded to outperform 850 euro target. Travis Perkins raised to buy after a terrible week. Danone and Nestle downgraded. Is that Danone a downgrade? Can't be downgrade to overweight. But Nestle cut to underweight there. Maybe the price target's come down in Danone. So, right, let's go back to those European names. We can see, Porsche up 40 basis points, LVMH up 20. Is that the only risers we've got in Europe? So, yeah, futures.
RWE, Elliott entry a couple of weeks ago. So
That's right.
That is impressive.
Nice defensive name, RWE.
We do love a bit of RWE. Peugeot Invest. Deutsche Telekom, that's defensive. That's probably, I would say Deutsche Telekom is my favorite telecom operator in Germany.
Touché. What other telecom operators are there in Germany, Ronnie?
None worth to be mentioned, mate.
Right, the French banks. So French banks really get hit hard yesterday. We had, the Italians as well. Of course, Commerzbank and Unicredito still ongoing. But we had, we see SocGen and BNP getting hit again. Stellantis was down 8% yesterday. It's down another 2% this morning. So this hangover is still there.
Stellantis is
not
down.
For me, but
the sky is blue, in other words. When are they up?
Right, what's happened to the S&P? S&P looking down 50 basis points. But let's look elsewhere. What is being priced in now? On this Friday morning into the world, we're seeing oil down 2%, 65.50 now. So a repricing of growth expectations, right? We've talked about it relative to earnings and GDP in the US. If the US slows, the rest of the world slows more. That's why I want to short some euro. Euro at 110.5 is just fantasy.
No. Slow down now. I think the most interesting stuff with the oil output is how OPEC are reacting to it, and they're sort of done the opposite of what one would expect. They're increasing output, aren't they?
Exactly.
Yeah, and in times like this, when prices are already going down, you're getting plummeted, and you have the US that are oil drill baby drill, then the OPEC countries are increasing output even further. I don't know, mate. What do we think oil can touch? Can we see 60. A 5 before?
Yeah.
As a first number.
Yeah. What's going to hold it up? If GDP is going to slow to 1%, as you said, right? That is a significant withdrawal from the demand side of the equation. Yeah. As you say, you've got supply coming on from Russia because.
Who were not in on the sanction list or the tariffs list as well.
Of course not. You've got increased supply from OPEC. You've got drill baby drill. Oil, I do not see support for that here. Let's have a look at the chart.
Rich, my fingers are tingling for a bet.
Oh, no. Well, choose your weapon, sir. You tell me what you want.
Okay. Do you think...
Wow. So, hang on, just look at how important these levels are for oil. My goodness me, we didn't realize. Look, every time there is support there in September, there was support there back in March 23, this is a really interesting level for oil, and I don't think that support holds.
You think we're blowing through that?
I think we're blowing through it.
Well, that leads to my question.
Bring it.
Can we see oil at 55? And if yes, when?
Well, that's two questions. If we're going to turn this into a poll, it can only be one question.
Okay, can we see oil?
Sub 60.
No, 55. Let's go a bit cheeky with it.
That's too far.
Okay.
Right. The poll of the day. Do you
Sub
think
60 before when?
May Day bank holiday. So the second bank holiday in May.
Okay.
The poll of the day, will we see oil sub $60 WTI before the end of May?
Yes.
Phil's going to tap away on screen there.
Are you taking that? Which side of that are you taking?
Yes.
What do you mean yes?
I'll literally be the first vote there.
Which side are you taking? And you reply yes.
Yeah, because it's a poll. Will we see oil sub 60 before the end of May? Yes.
Yes. No, but my question to you was, which side of that bet are you taking? And you replied yes.
Yes. So yes, I see it sub 60.
I was expecting long or short, but...
I'm short here, 65.
Okay. Yeah, but this is not fun because now we think the same thing.
Well, let's get short then. Let's
not fun
stop talking and sell it.
I also think it's going down to sub 60.
Right. How are we getting on? We got 14 votes already in the poll. We like this new YouTube. Is anybody stuck on the old YouTube? Yeah, that's a point actually. Look, we want to blow this YouTube up. We want to really get some traction. If you can hit that like button, I'd be very grateful on this Friday. If you're not subscribed, please subscribe. So all your options are there, are down here below. Subscribe, yeah, all that, the comment, share it to Ronnie's family. And yeah, but hit us with some love hearts, hit us with some thumbs up there. That would be much appreciated.
Desperate much?
Right, Ronnie, what are we going to cover in fast markets in about 3 minutes? I see your question, Boise, on Nike. I am still very much in because this is the time that I invest in things, right? Nike, it's not a trade anymore. It is a proper investment for me now. I think that negotiations happen. I think Vietnam tariffs come down. I think Chinese tariffs come down. And I think Nike is back above 60 within a matter of weeks. So that is, for me, it's opportunities like that you don't see very often. Deckers, I'm not so sure about. Deckers, hand up, I'm wrong on that.
What about, what was the name of the company? The Arc'teryx, the head of the Arc'teryx group. I sent you the picture of the parent company of Arc'teryx.
I don't know what Arc'teryx is.
Oh.
We'll do that in fast markets anyway. So yeah, any other questions you've got? I'll do a little bit more on Nike. We'll have a look at Barclays. What other stocks after this huge move down do you want us to cover in fast markets coming up in a couple of minutes? The poll, 29 votes in the poll for will we see oil sub 60 before the end of May? 65% of you think yes. I got to sell some then because we've been talking about this. I've watched it go down. I've watched it go to 65.30. It's already down 2% today. So that I was short yesterday. I closed it last night thinking it might bounce, but there we go, going back short, $2 a point. In this new world of discipline that I've not managed to stick to, we'll put a stop on there of 66.50. Yes, I should have listened to Axel. Well, you saw me cut a bit of Antofagasta, 2/3 of Antofagasta. I cut a third of Glencore, but a lot of me wants to buy that back. I bought some ETH this morning, but that's only for professional clients. I do not, small positions on crypto and leverage, not advisable. Well, small positions are advisable in crypto, but not on leverage. And yeah, hitting Adidas as well. 193.
I just got a message from my excellent manager, Tom Roberts, who filled in the knowledge gap. And Amer Sports is the parent company of Arc'teryx, who also own Wilson, you know, the tennis.
Wilson.
Yeah. So that's one we're going to look at in fast markets.
Okay, great. Right, we'll do a quick 2-minute break. Go make yourself a cup of tea. Monkey Man's already got the kettle on. I could do with a croissant or something this morning.
You sure, mate?
Woohoo! Touche. See you after the break. Welcome back, welcome back. So yeah, David Boyce holding me to account. He says, Rich, you had a stop loss on Nike. Did you use it? We go to the screen, you'll see it there. It was painfully, I was at lunch and there it is. Took a £500 hit on that. Sold the 200 shares, but saw them down there. Where were we? This is all my trades yesterday. I did buy them back at 55.51 yesterday. So, you know, I saved myself $2, but I'm sorry, Nike at 55.51. I just...
Question is if this is the bottom, mate.
Well, it might not be, but I will build a position that is now a conviction position.
I agree we've talked about Nike a lot on this show, and we both agree that it's a high quality stock that's on the bounce back. My question to you is, if we don't see a deal with Vietnam, or if we see a deal with Vietnam, how do you think that will affect both ways? Because obviously that's their main hub of production.
Well, then they've look. These companies have got incredible brains working for them, right? The supply chain will all shift, but it takes time.
Yeah,
and that will be the pain. Now, Nike say, right, we'll make a 10 billion investment into America, right? Boom, exemption.
Right. I see your point.
It's all negotiations.
It's all negotiations, absolutely. But a shift of supply chains. It's not as easy as switching software.
Remember, stocks are not a 1-year investment, right? Stocks are all the future profits brought back into today. So that representation, unless you're telling me that Vietnam is going to have tariffs on it for the next 10 years,
well, that I don't,
then that should come into the expectations.
Oh.
It comes at a terrible time for them because they're already on depressed earnings. But on depressed earnings is when you expand the multiple. So I'm happy to pay 30 times 2026 for Nike. So, you know, if that is a tariff adjusted 30 times, then I'm buying the company for a 5-year trade. That's how you have to think. Investment versus trade. Nike turns for a lot of stocks are now turning into investment criteria for me, which is why I've got 100% of my pension in cash, and that's why you start to now deploy it.
Okay, so your answer is, regardless if there's a Vietnam deal or not, you're still long Nike and bullish on them long term.
Yes.
Okay, I fully agree with you there.
Adidas is one I'm more likely to cut, right? Because they don't have that turnaround story and they don't have the support on a multiple. So I'm in it. I bought them at 201 yesterday. They're now at 194. You know, I'm going to put a stop loss on them of 189 right now.
And what about their little brother across town, Puma?
Oh, wouldn't touch it. Would not touch it.
I don't think I've ever bought a Puma gear or anything like that.
Now, that is a falling knife, if ever I have seen one. And, you know, and this is the problem. And I look, as I said before the break, I have got Deckers wrong. And I've got Deckers horribly wrong. And now what really worries me is I go into a shop like Office, and Deckers has got a smaller area, right? So now I'm starting to worry, not only do I have the stock wrong, but now Hoka is selling less as well. So the good thing is Uggs are back online. I spoke to them. They've got a full supply of Uggs.
You spoke to them?
Yeah.
With the IR team?
No, the people in the shoe shop.
Oh.
About the supply. That's how you do proper research, Ronnie. Right, you speak to people in shops.
Right, sorry.
So there was a big problem with UGG. That's why the stock dropped so violently from 220 to 150. UGGs are now fully available. Will
that compensate for the loss of revenue from the hookahs?
Well, this is the question. Is that true? Is that only, you know, is that Nike fighting for space that they've stolen it back? Is it On Running? I haven't looked at On Running for a long time, but they're smashing it still. That would be an interesting one. It's stupid now to sell out of Hoka and buy On Running instead, because the same thing might happen. But if I was really being sensible, that's 37 down from 63. Has that fallen as much as Hoka has? Not quite, but it's not far off.
It's, on this one, on holding, I have to throw all sort of analysis and everything out the window, because I bought an On Running pair of shoes a year or two ago and I just hated them.
Oh, really?
Yeah.
I'm not going to say what I was going to say. That's the first time I've actually bit my tongue on air.
Oh, blimey. We'll take it off air, mate.
What was it that you didn't like about the cushioning of the On Running?
Oh, were you going to say that the bubbles popped or what?
Nike Air Minimum.
That's why they told me to do stand-up and not you, mate.
Right, okay, next one, Uber.
Uber, yes. Uber is a company that I very much like the technology, and I like the fact that they are they've outsourced their partnership in self-driving cars. They haven't taken on the cost of building its own, because that's not what they do. They have instead partnered with the right firms. They're now at the leading edge of self-driving, unlike Tesla. They're also...
Tesla's at the leading edge of self-driving.
They're not as far up as competitors like Waymo, who are partnering with Uber.
Ah, right. Okay, sorry, I take it back.
Yeah, thank you. I also like that Uber are sort of developing into an everything transport app. I was on the Uber app yesterday, and you can now send packages. You can book your
Uber Eats.
I've never done that, mate. You can order your National Express bus tickets. You can order your train tickets there.
Yeah.
You can rent a car, and this is pre the Expedia potential merger that we all looking for and hope for. I think Uber potential merger. I think Uber is a stock that's been, it hasn't been loved as much as it should have been. Probably because it was very, very highly valued as a private company. So when it did go public, we had the scrutiny of the public markets. So I'm very bullish.
No tariffs?
No tariffs. What are you going to tariff, an Uber
It gets
driver?
hit by the economy, right? Because it is a discretionary spend. If I'm going out on a Thursday night, London traffic's crap, right? But I would consider paying £7.50 for an Uber rather than getting the tube.
For £3.50.
Yeah.
Exactly, that's what I mean. Or you take a Lime bike. Or you take a Lime bike, which is also part of it. It's not part of it, but they have a partnership.
Which is more expensive than the tube. Sometimes I think I'm crazy taking a Lime bike.
Yeah, but the exercise is always nice, mate.
Yeah. Exactly. On an electric bike, that's just your type of exercise.
Exactly.
So what do we do? Because this thing hasn't come down very much, and that's my problem. In that paying $70 for Uber, when Nvidia's dropped 40%, and this has dropped 13%.
Before I allow you to price me an option strategy on this, I also want to say that Bill Ackman of Pershing Square shares my opinion that Uber is undervalued, and he took quite a big piece of stock in it after their latest earnings.
Chart off, please, guys, just so I can put my account password in. Wakey, wakey, gallery, chart off. Thank you. So what month do you want to look at?
Ooh, I think that by the summertime, by summer, say mid-July, as tourism is picking up, traveling, partying, going out, clubbing, so will Ubers. So maybe I want third quarter earnings.
Okay.
I'm very bullish on those.
Right, that's going far out though, isn't it? I mean.
Okay.
Okay, but no, let's do it. It's your call. So October, let's look at October 17th.
Yeah.
What would you buy them no matter what? Do you want to buy these things at $60? If we go into an economic slowdown, Goldman's are right, 1% GDP growth, discretionary spend gets hit, these guys get smashed.
The way you feel about Nike is the way I feel about Uber.
Okay, so you buy them at 65.
Yeah,
right.
Easy.
Okay, so let's sell an October 65 put. And what would you like to do with that money? Invest it into a call spread?
Yeah.
How high do you think it can go?
We're at what, 69, 70 now?
Do you want to buy them here?
72.
Right, 72.5.
Yeah.
So we're now taking the premium that Ronnie is prepared to receive for obligating himself into buying them at 65 to then buy the upside, and I'm trying to get him into a low cost. So that's 250. See that 250? That's what his net spend would be trying to buy that structure. So therefore, we try and sell a $90. My goodness, this is a good trade. I like this.
That's what I mean. This is a good trade.
So Ronnie would now have the 72.5 to $90, the right to own Uber all the way up there to October, and he would get paid 50 cents for taking that risk.
Where's the risk, mate? I mean, you're telling me that Uber is not going to take up $3.
I will do that trade this afternoon. I love that trade.
Right.
Well done, Ronnie. Well done. Just for that, we're going to put you in to, we're going to award you with a place in this list. Revealed the 30 most powerful people under 30 in this room. Ronnie, you are going straight to the top. Look who's in there. I obviously know
No, Landon Norris.
with the Nielsen sisters. I know them well. They went round the Olympics with my flag when they won the 4x4.
Your flag?
Yeah.
Which flag?
I threw it to them out from the crowd.
Oh, very
my GB
cool.
flag. So, and that's my old team, Shaftesbury Barnet, in the black and white stripes there. But let's see if Ronnie makes it on. So who's more likely to make it on, you or Luke Cooper?
Luke Cooper. Maybe they confuse him with Gary Stevenson and put him up there.
Very good. Right. Okay. So Monkey Man wants us to look at LMT. So let's, of course, Monkey Man being our the OG of our viewers, Mr. Sir Monkey Man, we like to call him. Lockheed Martin. Ronnie, what's your thoughts?
Lockheed Martin, I think defensive stocks in. Oh wow, that's might have to stop myself there because that looks quite attractive. But I think defensive stocks in general, in my opinion, and I'm sure you share this, especially regarding European defensive stocks, but this is an American one, and I'm finding it hard to believe that they have much more to give. I think we saw a massive rally, right, with everything going on around the world, and now I think we're coming down to normalized levels, unless we see war break out, which I hope not. I don't see much upside in Lockheed Martin or any of the major defensive names, if I'm being completely honest. I think they've given us as much as they can in this period. What do you think?
Yeah, it's that area. I'd rather be long these than be long BAE, right?
Yeah.
I'd be happy to have that on as some kind of pair.
Quick one before we go.
Yeah.
Andrew McKelvey just gave a big shout out to IAG.
Yeah, let's take a look at
I
that.
very much agree with that.
Thanks, guys.
He's making complete sense that it looks cheap and it will benefit from lower oil and transatlantic flight, which is very, very fair judgment to make, and I agree with it.
Wrong one.
And we're also they've also received approval for Luton airport expansion. I'm not sure if they fly from Luton, but
that's EasyJet's hub. Are you sure about that?
I don't know. I've never flown from Luton. I'm a Heathrow guy only. But increased traffic and lower oil prices is something that I think is very, very good for it. And we're getting close to that 250 price level that we were talking about earlier. So
this does, £3.60 back to £2.40. That is a great shout, Andrew McKelvey.
It's basically given back.
You in there.
It's basically given back all the gains that he got from that major upgrade by Jeffries.
Okay, I'm buying 6,000 shares, 241 spot 8. Andrew McKelvey, thank you for that idea. I like that a lot. That's us, Ronnie. The time has come again to launch you back into the world. Some call throw it back like you're getting fishing.
Yes, well, the best part of my day is to greet you, and the worst part of my day is to leave you, Rich. But
this is why my sister now texts me after the show. Oh, he's such a nice guy, isn't he?
But I am now going to fulfill my duties of optimizing client experience and value generation for our clients and our shareholders. So you will catch me on the lines of IG.
Brilliant. On that, Chris Beecham and Angeline coming up next. And then we've got a special coming after we open the all sessions. So you'll see the 9 a.m. all sessions with the S&P currently down 50 basis points. The NASDAQ down 40 basis points. Nasdaq down less. I'm going to go through an interview with Mohammed El Arian, who is one of the real geniuses out there. He teaches at Oxford. He used to work for PIMCO, and he gave his excellent analysis of the current situation with tariffs, with his 3 S's, that this is structural, this is secular, and it is systemic. So I'll be going through that at about 9:05. Stay online, take your Friday off, don't go up to Liverpool like I should be. We'll see you in 2 minutes.
Hey, welcome to Live from the Trade Desk with myself and the one, the only Chris Beecher. Morning, Chris. How are you?
I'm very well, considering the busy
Considering
week
the
we've had.
devastation.
I forgot what a proper sell-off was like.
I know.
I think it's really a kind of I can't remember. I mean, August maybe last year, but I can't remember the last since 2022. Really, it was like this, and you forget really. We go through these periods where volatility just doesn't happen, and then suddenly it does. And I've said about the past week, it sounds awful, but it is so much easier to write just commentary, especially for press, on a down day. On a day where the market's gone up slightly, it can be quite painful, to be honest with you, trying to say something interesting. But a day when everything is just moving, you are just not short of stuff to write about. So I think the global analyst team have felt this week their job is slightly easier, at least, in trying to write stuff that is at least headline grabbing, really.
Exactly, and it wasn't that long ago when Rich asked me yesterday, what I thought was going to be the level for the S&P, and I said, I think it's going to be a lot worse than expected. I think it's going to be a lot worse than what the options chain was indicating. And look, we are far closer to that 5,250. I think someone on the chat yesterday said, 5,300. I mean, it was just a bloodbath, wasn't it? At one point last night, I was looking at the charts. Apple down some 9% at one point, and we're just seeing all these records at the moment. Guys, let me just come off my charts for a second as Chris tells us what you were seeing last night. Do you remember the last time you saw this much volatility?
Well, I think it's got to be some point in 2022, really. And the question is now really how long it goes on for. Because if you think back to August of last year, even by the afternoon of that Monday, when we had the slump in Japanese markets and it fed through to the US, even by the afternoon, it seemed to just calm down. But this one went all day and kept going. And I think it's how extended is this sell-off? It's certainly the short-term sell-off, because you will look, as I was talking to the clients yesterday, we had the client workshop in the office, and you see these bigger swings below the 200-day moving average in any market. You tend to see bigger swings in both directions, and that's what we're going to get here. So be prepared for shock rebounds as well. But it's the two-way movement is so much more dramatic at the moment. We expect it to be extended really at the moment and to go on for quite a while. I'm just looking at some of the biggest top. I mean, there were 3 stocks. Believe it or not, there were 3 stocks yesterday in the S&P that made new record highs. But otherwise, clearly, the losses are just astonishing.
And we are seeing that mood continue into Europe as well. Germany 40, they're down 1%. FTSE 100 down 0.75%, I think, is the volatility index, because the volatility index, at one point did touch 26.
I think you should be calling it the fear index. Really, it is its proper name. Its proper name, really, at this point. But yeah, it's. Sorry, you run out of things to really. The superlatives just sort of get away from you on a day like yesterday. It really is quite mad.
It was quite mad. Let's have a look at some of the front pages. And Ariane, this is CNBC. They're saying U.S. recession risks are now uncomfortably high. We saw the risk off as well spread across Asia. Nikkei falling more than 3%. Just now we showed you the European stock reaction there. Also, Bloomberg. As you said, the superlatives are just, everyone's like worst, biggest drop, most astounding move, right? We're seeing that across the Twitter sphere as well. But the one that I found most interesting, did you see Trump's response when the market meltdown was in play?
Oh, and somebody asked him, how's it going?
Yeah. Did you see that?
Oh, yeah, it was
going well.
It was okay. It was going well. Going really well. All good. And then, And so there was a really good chart yesterday that showed the percentage of US equity ownership by US population. The top 20% of the wealthiest people, the top wealthiest 20%, own about 50%, it's like 60-70% of all US stocks. So this is his base. He's appealing to all the people out there who don't own stocks. This is the Main Street versus Wall Street argument. You saw that on Wednesday with the Union of Auto Workers.
Are you talking about
in
Brian?
The crowd. Yeah, is it Brian? I didn't catch the name.
Brian.
I was just too busy. Yeah, exactly. And that's what he's going for. And it's almost sort of the words I found yesterday were sort of Peronist South American dictatorship kind of thing. It's turning inwards, import substitution. It's the sort of playbook of these countries that sort of move towards autarky, and which is a thing you may of us will remember from our economics at school, the idea of being completely self-contained. Doesn't usually work, but it's the sort of turn inwards, and we are now purely for the base, purely for that working class, and it's binding them to him in such a way. And then you've got the comments you don't on Twitter about you don't need to buy an iPhone, you don't need to buy all this stuff because it's unnecessary. So we've gone from an American dream, an American acceptation to you can weather this storm and you don't need all the nice stuff anyway, which is quite a change really in tone.
I bet the climate enthusiasts are very happy about this.
Well, exactly.
Quite frankly, there's a huge thing as well on that was being debated about, who pays for the tariff first, right?
Yeah.
Who effectively pays for it first? And it'll be US consumers who pay for this first.
Well, that's what everyone knows, apart from the administration, who continue to insist that it's.
I would give my right arm to be part of the meetings taking place right now before JP speaks tonight. It would be incredible, wouldn't it? I mean, you know,
be
here
a
are
fly
the
on the
questions
wall
you might have to
with Powell.
prepare for from the floor, JP.
Yeah.
And
It's going to be a live one, isn't it? Where the questions, and if they're not journalist questions, they could be completely anything, and that means he's so at risk of annoying the man in the White House. Or I don't know, has Trump gone off to Florida now by now for the weekend? So that's that, you know, job done, global economy upended, time for some golf. That's, I think, what's kind of happening at the moment. Yeah, it is also noted that Fox News carried almost none of the market movement yesterday on its reporting. There was about a 2-minute segment from what I can gather. Otherwise, there was no sort of live ticker on the screen for this yesterday, which is interesting to say the least.
let's take a look quickly at volatility, because here we try and give our clients as much skew as possible. We are still seeing, you know, quite punchy numbers for volatility. They're showing the US 500, and here we are at around 49. This is the weekly, but actually it is the daily because it expires, you know, today. But let's look further out, and you can see that it is easing slightly now. The question now is that whether or not we are going to see this hold throughout Friday, this selling momentum, although volatility is slightly easing. In terms of Monday to Tuesday, after you've had your weekend, after maybe Trump has done a bit of golf in Florida, Monday, Tuesday options looking at around, we're seeing 27% from Monday. So still very, very punchy out there. Chris, what is your gut feel for what's going to happen after the weekend?
Oh, Lord. You've got with payrolls, they're not an afterthought. We shouldn't say that, but they're almost an afterthought if they don't
remind
really.
me again, what time
much,
is JP speaking? Is it this? It's late, isn't it?
4:25 according to my calendar. He's speaking about the economic outlook at the Society for Advancing Business Editing and Writing annual conference, which is probably as exciting as it sounds, to be fair to them. But I think obviously the speech is now suddenly taken on a life of its own, really.
Yeah.
But we don't expect many fireworks around payrolls unless you get maybe a whopping miss in terms of the actual headline number and people start to fret. But I think beyond that, the negative tone continues in one sense. Now, the problem is, of course, you've already had a big move to the downside in the short term. You've got key level watching 5,400 on the S&P may be key. If you can recover that in the short term, maybe you've got a bit of a bounce in the offing and it does then rally for a short time, and hope will rise again that we've seen the low and that people have factored in all the good news. Is he kitchen sinked it? Has he got all the bad news in with the tariffs already? And then can we just start to rally from here? But I think rallies will probably continue to be sold in this market, as we saw in late March. You had the initial slump from the February record highs to the March low, then it rebounded in the space of about 2 weeks, and then we took off again to the downside. Because we know now, the theme of the last 2 weeks has been 2nd of April, clarity on tariffs. We all know what's coming next. Boy, did we get clarity. Boy, did we know what happens now. And it's not great. And so far, there's been no immediate, the tone from global leaders has been not an immediate, well, I'm off to Washington now, I'll see you later, I'm going to try and talk him out a bit. It's been, well, we'll think about it and we'll work out our responses. They're not rushing.
Well, Ronnie made a good point earlier.
Negotiate.
Yeah, Ronnie made a good point earlier and said, you know, if anyone's worked with Brussels or had to, you know, work markets based on, you know, how fast, I'm saying that with a smirk on my face, how fast Brussels, you know, come together to get a...
You remember the Eurozone crisis.
And the Brexit malarkey,
exactly.
which just went on and on. I mean, to get them to all agree to something really quickly, that's almost like, you know, waiting for, you know, pigs to kind of fly. I mean, it doesn't happen. Brussels is not known for agreeing anything very quickly.
No, exactly.
So, you know, so I don't think we're going to get any sort of deal from that side anytime soon. China, however, China has been known to, you know, come to the table very quickly and make decisions very quickly. So that might be where we see the action first. You in the camp where we're going to get some sort of respite April 11th, or you in the camp that thinks that actually we're going to have a lot of this roller coaster from now on and not much in the way of a, you know, roll back anytime soon?
I think we're in it for a while now. If you look at his comments yesterday and Lutnick's comments in various media outlets, it wasn't even, they said, oh, even if you lower the tariff barriers, that's one thing, but it's the non-tariff barriers we're worried about now. So it's not just the sheer level, and you feel the goalpost being moved to an extent on this. But I think that's the thing. It won't just be these kind of tariff negotiations. It will be other things. This is, again, it's art of the deal, to bring up that terrible phrase again. It's about trying to bring countries into line with what the US wants. I mean, if you're Denmark trying to negotiate this, Greenland is going to come up at some point as well. So I expect for markets there will be false dawns along the way, perhaps, with the VIX up at 26 and probably going to go higher. You can expect the volatility around these headlines. But for the time being, with recession risk rising, the likelihood that inflation is rising, that job growth is probably going to slow quite a bit. You had reports of 2 car firms yesterday shuttering plants in Mexico and the US off the back of this news. So much for the boost to employment. This is going to be continued worries about US recession, and it's really, I think JP Morgan upgraded it to a 60% chance of recession in the US.
Yeah,
so it's moving in that direction.
It is indeed, and also the move in the Mag 7 overnight was just nothing short of astounding. Collectively, they lost more than $1 trillion. $1 trillion in one session of trading. I mean, this is unreal, this move. Putting up Apple's share price there, I have Apple, and I looked at one point, and last night it was like down 9%. It was unbelievable. What happens now? I mean, you have people who say, oh, and especially on the Twitter sphere, now's the time, now's the time to go shopping. Now's the time to start, getting all these bargain stocks. But I think it can go lower. My humble opinion is we are only at the start of this, real kind of almost like reversal of the theme we've seen in the last 5-10 years, right? We can go lower from here, because the only thing that is consistent about this administration is uncertainty, and that is not good for any business, whichever way you cut it.
No, it's not. Markets overshoot to the upside in terms of, if you like, the euphoria of last year and American exceptionalism, and Trump will deregulate and all be wonderful straight away. And they also overcorrect to the downside. And I suspect this isn't, because we are now operating below the 200-day moving average. We've had a lower high. Rallies are now suspect until proven otherwise, I think, is the way to look at it. This isn't the market of the last 2 years where it comes off for a while and then it bounces. You just wait for the indicators to turn. If you look at things like breadth, if you look at the put-call ratios, it will be interesting to see, really, in terms of price action. It wouldn't be surprising to see it into next week begin to rally a bit. Maybe as earnings season just gets underway. That's going to be fun, by the way. Earnings season, what fun that's going to be. If you get a bounce, maybe what happens when the S&P gets back to 5,600 again? Where will be, can it stay above these levels? And you're just going to have to be careful and accept that because volatility is high, your position sizes will need to be lower and your stocks wider. And it's the understanding that you probably shouldn't try to call these lows. If you, by some miracle, you do at some point, and you do buy it and it rallies and then continues to rally, and that is the low, then well done. But it's not easy to do, and it's certainly going to be very tough to say, okay, that's the end of it and we don't worry, because, as I say, it comes back to the macro picture more than ever of, well, there could be more tariffs. If we get retaliation, does he jack up tariffs even further? And we're on recession watch at this point. It's back to the complete inverse of where we were in 2022, when it was that 100% chance of US recession. It's definitely going to happen. We went from that to everyone says soft landing throughout 2024, and we've just about got the soft landing, but Trump's now rather nixed it, unfortunately. So now people have gone, to say the least.
30 seconds to go. We do have some chinks of light. Whilst the devastation was widespread, might I add, taking place across the markets, we did have a glimmer of light from the bond market. We had bond prices rallying whilst risk assets took a beating. Also, some questions coming in thick and fast. Monkey Man saying, if I was EU leader, I'd make comments after European markets had closed, but with US still open, it was always going to be interesting. Also, having a look at Andrew McKilvey very quickly. That's a really good question. Andrew here asking us, Chris, IAG, is it now time to buy IAG given the price of oil recently? Having a look at IAG here.
Look at that question. I know we were talking about with Richard a little while ago. It's been I arguably it was a classic case of they went up too far and they've probably come down too far in the short term. But I think it's now not about necessarily about the oil price. It's more about just the global macro backdrop. I was going to say macro backdrop and the outlook for business and or business class flights. Because if we're in recession or we're in certainly a period of reduced corporate spending, that's going to be tough for them, really. So they had a fantastic run in 2024, but certainly come a cropper, to say the least.
Yeah, and that is a good point, because if you are thinking about IAG, Andrew, bearing in mind that a lot of people are going to wake up this week feeling a bit less assured of their bank balances and pensions and feeling a bit poorer in their pockets. So the picture for airlines might no longer be how cheap or how low oil prices can go, but actually, are people now less willing to travel? Right, stay with us because we've got market measures coming up next with Rich, and all sessions as well. So stay right there. It's going to be a wild ride.
Right, here we go. So, is more carnage ahead on the open in 40 seconds time? It looks like it from the futures. We've seen an early indication that the algos are back in selling all those affected stocks in Europe. So, are we going to see the same in the US? It looks likely. So, expect all the same stocks to be down. The banks lower, the retailers lower. Will be interesting in the tech. Tech could be slightly mixed. Let's see what is going to be happening, and if there are any winners, will they be going for the defensives, money flowing into defensives like it is in Europe? So it'll take a few seconds for everything to kick off. Do we want to look at the winners or the losers first? I'd say it's going to have to be the losers, unfortunately. So there we are, and we see, okay, Home Depot down. Well, I think there's a bit of a widespread on that one, some widespread on a lot of them, but let's see if we can get this again. The team being careful there on, okay, Microsoft. Now, Microsoft was only down 2.7% yesterday, so it's understandable that one is down a further 1%. Visa, I can understand being lower, but yeah, nothing. Ronnie's favorite Uber that we're going to put the options trade on later on. That's down 80 basis points. And Palantir down at 83. Never got down to that 81 level that it saw the previous evening. Palantir actually managing to hold strong. Berkshire Hathaway, we've down to $525. Apple trading small lower, 40 basis points. Tesla unchanged. Tesla down at $267. Let's go back up to the top and go to the winners. Who are the winners on this day? Well, there it is. It's the Treasury bonds. Where to be in safety, in true safety, it is in those Treasury bonds at the moment. But are yields getting down to a point? There's a real argument going on, right? There's a fight in the world of sovereign bonds, and that is, can interest rates come lower while you're getting inflationary tariffs being applied? There's a real confusion in the market. There's a real two-way pool, because if we want to take a look at where the 2-year and 10-year are at this moment in time, you can see now the 2-year at 363. That is now a fourth rate cut starting to get priced in. I just do not think that is realistic at all. So we're talking 363 in the 2-year. The 10-year is 395, right? The 10-year now below 4%. That is why you're seeing the best performer on the day being those the 20-year Treasury bond. Right, Nike, small bounce, thank goodness for that. 56, let's see how long that lasts. Nvidia also a small bounce, 102 for those of you that picked up the cheap ones yesterday, into the 101s. We've got Intel at 2250, fairly stable. Walt Disney unchanged. Interesting, down at 89. Start to think about selling those puts in Disney, maybe at the 85 level today. That's one to think about. Haven't seen Snow White, not sure what to go on there. And right, let's see if we've got a better indication. Losers yet? Not really. Okay, that's, yeah. We let's see where we're sitting. We're with the all sessions open. We're still down 40 points on the US tech. Volatility up a further 2.5%. Oh, it's at that 25 level. I do not like that 25 level. If that holds until the end of Monday, then I will start to get very concerned. But who better to speak to on a day like this, after we've seen the last 36 hours, than our market guru, Elliot Harris. He's coming up in Trade Expectations right now. Elliot, come dish us out some of that wisdom.
Morning, Richard. God, what a market this is. Wow. Strap yourself in, I say.
There's not many times we get days like yesterday, is there?
no, yesterday was a proper old school flush out, if you like. I read that there was over $2 billion of selling of the June S&P pre-cash open.
I mean, that's never been seen before, has it?
Yeah. Now, this isn't just retail. This is real money, all the funds, everyone just getting out of US risk.
So take us through the day as it progressed. Then, as you watched every single minute of that action.
Yeah. So I covered the US shift. So logged on about 1 o'clock, and actually it felt like I also worked. I jumped on to help out just during the Trump speech, and I kind of sat there. It all started very slowly, and then he got his big board out, and the market just went ta-da. That was aggressive as it seems. It really was. Yeah, most of the move, I'd say, the move is probably more aggressive pre-cash opened yesterday than after. It was just a slow grind lower, really, as opposed to any sort of panic.
Which we see so often, don't we, nowadays in this new sort of algo zero DTE world?
Certainly more often than we did, but you do still get aggressive moves. For us on the options desk, probably our busiest day since the craziness of August the 5th.
Yeah.
So it was a lively one. Today's very similar. All right, today's maybe a bit more of a faster grind lower. But we obviously do Monday options, Wednesday options, and the vol there is still ticking up. So what, VIX now, we're on a 27 handle on the front month. Not seen that for a long time.
I do not like those numbers above 25. They really, really concern me. Have we got the April 11th Monday contract listed yet? That's the one that I think is going to be really key.
No, so the Monday will be the 9th.
The Monday's the 9th, sorry. Yeah.
Sorry. Yeah. The Monday's the 7th, the Wednesday's the 9th. So we only do 1 week. Yes, we've only got the 7th. I'll tell you the vol on that. The vol on the 7th is, bear with me 1 sec.
Well, if the reason, of course, I'm interested in the 9th especially is because that is tariff day, right? That's the day that everything comes into effect. Therefore, I think the negotiations get announced on the evening of the 8th or during the 9th. Therefore, that is the one that I'd love to look at with you right now. Some kind of upside idea, some kind of play.
Yeah, so in terms of the difference between vol, you've got roughly 29% at the money on the Monday. The Wednesday carries slightly more weight. So you've got around 30.5. So, yeah, so it's beginning to be priced in, that sort of expectation.
Okay. And, well, where have we come from?
Oh.
Where have we come from? Where do we go? Where do you see us?
I thought you were about to sing Cotton Eye Joe there.
I was waiting for you to come in with the last line.
Whatever you take me. Nothing's cheap now. It's really not. Even though we've come so far, you might think, okay, all right, we've kind of broken out of this range that we've been stuck in for a couple of months now.
Yeah.
Can we get, say, back up through 55, 50, 56? But even a 56 call for Wednesday, you're paying roughly 6.5.
But up there, I'm more interested in what I'm receiving.
Okay. Yeah. All right. So, what are you thinking of? A 2x1 maybe, or?
So, right. Okay. Let's have a look at the chart first of all and see what we could see from this. Let me get SP 500. Okay. We on the announcement. Let's go to a 30-minute chart. Well, 5,600. So let's say it could get, in a dream scenario, it could get as high as 5,625.
Okay. So 56, 25 call. You're only really going to receive roughly 3.5.
But I'm happy to break even there, right? Because the rest of the world's all right, and a lot of other positions are gonna come right for me. So, what about if something like 55.50? We sell 2 of those. How much do we get for that?
Received just over 12 per side, so 24 is the total.
24, right? So if I go back to my options, right, so this is the 9th of April we're looking at, people. What can I buy for 35 ticks then? About a 54.60?
Near enough, yeah.
All right, so 54.60, I'd pay 30.60, and then 55.50, I'd sell 2 of those, and I'd receive 24.
Yeah,
24.
So overall,
then
overall 12.
I'm 12 ticks for 90 points of upside. What? Go on. How do we get better than that? Sell some downside. What do I have to sell?
That's probably where I would be looking, because the skew has popped out so alarmingly.
Yeah.
It's not just kind of the closer to the money stuff. It's like even on the wings, even on your sub probably 10 delta stuff, the skew there has been kicked really, really aggressively. I'm just in the process of actually adding on a few more strikes at the moment. Quick nod, we've just actually made a significant improvement to our S&P pricing. Hopefully
noticed.
those clients who trade S&P options will be able to see that the pricing is a lot smoother. We are generally tighter. We've had to maybe go slightly wider, but that's kind of market driven, if you like, because of the vol. But certainly during the announcement, we priced it incredibly well. We really did. So a long overdue pricing improvement I've been working on for about a year. So
really
great to get it
impressive,
out.
mate. Well done on that. Absolutely. Okay, so let's sell a 5,100 against this.
Yeah, so if that you receive 16, or let's say sell a 50-50.
A
Just give you
50-50
another
for 12.
50. Yeah, exactly.
Okay.
And then it's at 0 cost.
Right, so that is 0 cost. So selling a 50-50.
Yep.
There we go. That summarizes the chance of this working or not, of it going up or going down. 50-50. We're buying a 5,460. Okay, I'm going to bring it down then, because I'm happy to pay 10 points to get into this. So if I pay you 10 points, I can get a 54.40.
54.40 cost you touch more, cost you roughly 43. So what you're paying 43, selling, receiving 24, costing you 19. Yeah, you might even want to push your sell side leg slightly further, and maybe go for the 5,000 and receive 9, and there's your cost of 10.
Rather than so take my risk lower rather than taking my call lower. Okay.
Yep.
Yeah, I really like something like that. I'm just not sure. The 9th feels right, because of course I've got till 9 p.m. on the 9th.
Yep.
Okay. Can I walk you through what Mohammed El Arian thinks on this whole palaver?
Yep.
So it was a really good interview. So he thinks now we're on a 50% probability of a US recession, so higher than Goldman's thought of 35%. He puts that together with now 3.5% on inflation expectations, right? That combination worries the Federal Reserve a lot, because recession, higher unemployment, but inflation expectations being de-anchored means that the Fed has to choose between which one of their mandates they go for.
Yep.
Every business leader that he speaks to thinks that there is going to be a hit on their costs, as in costs are going to go up, revenues are going to drop, right? So that is looking at, especially painful. So they've got to do something. They've got to try and raise prices. That's where your inflation expectations is coming from. We've now seen in the bond market, we're pricing in a fourth cut, Elliot, for the Fed this year.
Yeah, there's been quite a shift there in the last 24, 36 hours. Pricing now close to a whole basis point.
I think that's fantasy land.
I think that's very aggressive as well. Yeah.
So how do we take advantage of that? I'm guessing I've got to short some two-year treasuries.
Yeah, maybe look at the 2-year or the 5-year. Yeah, seeing a little bit of movement on those today.
Yeah.
Yeah, for me, it does feel a bit of an overreaction. But I think the move yesterday and the move that we're seeing overnight is that the market is, yes, absolutely. We all fully expected a decent tax increase. The scale of the tax increases have been way, way, way beyond, I think, anyone expected. There's a saying in the market that America sneezes and the rest of the world catches a cold.
That's it.
I listened to a call earlier from UBS. I find their research excellent. And it said, this isn't US sneezing, this is US actually cutting off their arm with a blunt penknife. It's quite a nice way to put it, I thought, yeah.
Both arms.
Yeah.
So I think, and L. Arian said the same thing. He thinks one rate cut. If we actually had a normal Fed that wasn't this new age Fed, you wouldn't get any rate cuts at all. So what does that do to consumer sentiment?
Several speakers have kind of been quite open about we're still planning on waiting for the data. We're data driven, but that isn't going to hold for much longer. And all right, Powell, he speaks a bit later this afternoon after 4:00.
Yeah.
He's probably going to deliver a similar sort of message, but they're under significant pressure now to show some action.
I wonder
if
if
backed into a corner, I feel.
I wonder if that's where we see the low of the day. I wonder if the low of the day is halfway through that Powell speech.
I wouldn't be surprised. We often see that, actually, that you do get the low often around the European close. Around about 5:00. Yeah, so that will kind of time very closely. So I wouldn't be shocked to see that. That could be a good call.
It could look properly scary at that point, though, couldn't it? We could be anything.
Yeah, today's not got aggressive, but saying that DAX shed another 300 points, I'd say, in the last hour or so. So
that's it. Yeah.
But yeah, the US isn't. It's not a panic sell-off. What S&P's down 46, Dow off another 400, Nasdaq off roughly 100 points. It's still a grind as opposed to a flash mob, if you like.
Right, with your UBS analogy then, the sneeze, the cutting the arm off, what happens to the rest of the world, right? Because the weak dollar is what I do not get. Morgan Stanley saying no rate cuts this year. L. Arian saying one rate cut this year. The market saying 4, right? So we're seeing that dollar weakness. Dollar weakness doesn't make sense to me.
Yeah, I read about this on the train coming in. It's just the whole concept of US exceptionalism has just been smashed to bits. So the market has been so keen to kind of hold on to that for quite some time now.
But if you don't have that, who is exceptional?
This is $1 million question. Yeah, where does that favoritism almost go to?
Yeah, and I tell you what, it's not Europe. I'm sorry, but just because you're spending 500 billion on defence does not make that suddenly make you exceptional with that absolute racket that goes on in Brussels. So on that, I am selling some euro dollar. I'm very happy to go short euro dollar. And I'll be doing that here at 110. I'm already short at 110.36. I'm going to double that at 110 on the button because I do not see, and I'm going to do that treasury trade shortly as well. I just don't see how, as the world comes to grips with what is about to happen, even if tariffs are walked back, which I strongly believe they will be in the next week.
Yeah, I think they will be as well. Yeah.
It doesn't lead me to a bullish rest of world scenario.
Yeah, 4 cuts is overkill. I think the world would be shocked if there's 0-1. I think it would come as a surprise. So it definitely lies somewhere in the middle. For me, I'd probably stick my hat on 2. I think we see 2, possibly 3. Yeah. Question is, are they going to cut in May, or will they wait until June, which is kind of where the market was pricing in beforehand?
Fair. Yeah.
Yeah, it's hard because it's almost your macro teaching almost goes slightly out of the window, just because we've not seen tariffs this high since probably the 1920s.
I did ask Chris Beecham how it was back in those days. Of course, because he's a historian, not because he's got grey hair and is old.
Absolutely, yeah.
Right, there's our 2-year note. So that is what the the gallery loving jumping in, telling them that I'm actually, you, Elliot, I and Chris Beecham are very similar. I think we would all be enjoying the same kind of 80s music in our childhood.
Yes, I've just actually, after maybe one too many client lunches and enjoying myself a bit too much, let my hair down, so to speak. I've just actually come across my first case of gout, which for those viewers who have had this, oh man, it's just brutal. It's yeah.
What's the symptoms? Just because we do have a lot of men on the chat of similar age, and I think it is quite a male thing, isn't it?
It's definitely a male thing, yeah.
What are the symptoms?
It starts in your big toe. So I play tennis to quite a good standard. So I had a match on the Wednesday night, woke up on the Thursday, could hardly walk. I thought, okay, I've probably hurt my toes somehow. It's kind of stumbled into work Thursday, Friday. And over the weekend, I was hobbling about, much to my wife's absolute delight to see me stumbling around.
Oh, buddy.
Monday and Tuesday, I can't get a pair of shoes on.
Oh, so it's inflammatory is the key.
Yeah.
Right.
Yeah. So it all starts in your big toe, and it feels like you've broken your toe. And my father and brother have had it, and I've always thought, oh no, yeah,
not a healthy man like you.
Exactly. Yeah. But yeah.
Oh, so. Right. Well, there we go. Our community appreciates your pain and wishes you well. Let's take a really quick look at the economic calendar today. I've shorted some of those 2-year treasuries that we saw on screen, 104.10. Let's see what we've got on the economic calendar for today. So it is looking at Friday the 4th of April, non-farm payrolls, once that comes up. Non-farm payrolls, of course, we've got expectations is 100,000, Elliot. What's your shout for that?
Yeah, I'm reading slightly higher. So I think we could maybe have 130, 140 possibly.
Okay, that would be a big relief. Unemployment rate, 4.2?
Yeah, I don't think we'll sway too much from that, but I'd like to see those figures over the next 2 to 3 months. I think there'll be a little bit of pressure on that. That's
the thing, isn't it? Maybe 4.1 today would be the best scenario for the market. And then as you say, Fed Chair Powell's speech. So we get a panic into the European close. It pukes, it bottoms, Powell comes out, saves the world, and we could all have a happy Friday evening.
Save the world / maybe puts out a fire or two.
Right. Yeah. Last thing before you go.
S&P Volt today is around about 50%. That's the highest we've been for quite some time on a non-farm. So market is pretty excited about this.
So what's the expected move? Sorry, Elliot.
You've caught me there. I'd have to work there. Roughly 80 bids. It's similar to where you were this time yesterday.
Okay.
Let me just do my maths 1 second.
That's interesting.
Roughly 1.5%.
Okay. Okay. And finally, who's going to win the Grand National that I will not be at?
Stumptown is the one I like. Won the cross country at Cheltenham. So, but there's been a lot of money for the favourite Willie Mullins, linked to do a red rum, winning it off top rate, which is quite an achievement. So those are the two. Stumptown and I Am. Yeah. So Stumptown and I Am Maximus.
Oh, we like I Am Maximus. That is that's one of our guys in the chat's names as well. Maximus Leverage. Okay, well, let's hope it's not Stumptown result of that gout that you've got. We'll see you shortly, Elliot. Have a great weekend.
Cheers, Rich.
Hey, welcome back to Live from the Trade Desk with myself and Ron. How are you?
Good morning. Yeah, I'm very well, thank you. How are you?
I'm very good
from last
indeed.
night,
Very good.
I assume.
Did you watch the carnage? Did you watch the
I
train
did.
wreck? Nothing
I
was
was-
spared. Pretty much nothing.
I was flipping between different financial news channels just to sort of see the different takes on it, and Bloomberg and CNBC, even CNN. I was flicking between basically all the news channels, and yeah, it's just quite funny to see how different people are digesting. The biggest fall in equity since 2020, really.
Yeah, I saw the sea of red continuing, and then I think the point which I kind of thought I need to shut down now before I start getting nightmares is when that tweet from I think who is it? Not El Arian, but Bloomberg was quoting El Arian saying that the risk of recession is now very, very high.
60%, they say.
Yeah, exactly. And then my tweet deck at the same time had all the reports of Trump saying it's going well, it's going well.
Yeah.
That's like, okay, sure.
Well, yeah.
Yeah.
Well, he said, this is expected.
Yeah.
That's what he said.
So, with that in mind, it is really just such a huge reaction this morning. Again, for all the trader friends joining us now, we're seeing continued risk off here on the markets. Germany 40 now. Further losses there, down 1.5%. FTSE also down 1%. So we're seeing a steepening of losses there. Banking shares leading, European stocks lower, and the stocks is set for its biggest weekly fall in 3 years. I mean, as a portfolio manager, Ron, what goes through your mind? I'm sure everyone wants to know this. It goes, when you see all these big numbers and big headlines coming through talking about the carnage on the markets.
Well, believe it or not, I can't actually control the markets, so I just have to, see what happens, and then.
I thought you had your Amazon crystal ball.
Well, I seem to have lost it because the markets aren't doing it. They're not really behaving at the minute. If you're sort of long equities, but it's one of those things where if you're investing for a long period, more than 5 or 10 years, you're going to get bouts of volatility. You're going to get corrections. You're going to get bear markets. You're going to get all sorts of chaotic events which occur. And the only solution to that is what's called a systematic risk when the broad market sells off. And the only really solution to that is just to be as diversified as you can, because it's not something you can eliminate. It's systematic. So it is depressing opening up the Bloomberg terminal and seeing red everywhere. But you just have to sort of ensure that you're comfortable with your positioning relative to the risk you can take in the portfolios, really.
Yeah, and
so,
just
I try and stay calm.
Try and stay calm. So you think this is, and that's what we always say here too, because you ride the waves if you're a longer term investor. Some of our trader friends, chiming in and are really back this too. It's all about duration, right? But for those who are intraday, who are traders, this is a buying opportunity. And also, it's such an amazing thing. We've been waiting for volatility for such a long time. If you short the market, this is like kind of your party time, really, because everywhere you look, there's an opportunity. Plus, all this weakness tells you, what it's telling me is we might actually see further weakness. Maybe this might turn around. April 11th is the first sort of date when everyone's thinking maybe we might see some sort of respite, repeal, that Trump roll back, roll forward, roller coaster that we've been seeing for some time. But at the moment, we're still seeing this broad-based sell-off. Just checking in on the VIX as well, because were you watching this yesterday when it briefly touched that 26 handle?
Absolutely, yeah. I was keeping an eye on all sorts of things, even commodities getting caught up in the sell-off with crude falling as well. So volatility really across the board. Apart from in treasuries, I think the 10-year went below 4% briefly. So that's the only area of solace. So that's my favourite position at the moment in our portfolios. All the green ones.
All the green ones. Well, let's have a look at, before we get to the green ones, let's have a look at the picture so far across Europe, and this is currently the change, and this is data from LSEG, and you can see there, lots and lots of moves there still, and
it's very unsurprising.
Yeah, we just had Elliot Harris on as well, saying that in terms of the volatility perspective, it is unlikely to see a bottoming until maybe around the European close, if it does bottom out. So,
well, from a long-term perspective, we tend to look at two things really, I would say: valuations and sentiment. And we knew that valuations going into this year were frothy. The froth has been taken out. The Magnificent Seven are down quite extensively this year, and they were the key drivers. I think they drove something like 60+% of gains last year.
Keep talking. I'm going to put up the Mag 7, my Mag 7 list here.
And there hasn't obviously been a change in the sentiment, which is we're in a bit of a risk-off, concerned mode with this tariffs and the uncertainty that tariffs can bring, economic uncertainty and inflation. So from sort of that long-term perspective, unless we get clarity on what's going to happen with tariffs, because still, even though he produced this sort of really broad list, like restaurant menu of tariffs, he even said, that they're subject to change if someone makes good offers and good deals. So there's still uncertainty, even though he had this huge Liberation Day speech. So a lot to keep our eye on still.
It's interesting you say a restaurant board, because when he brought out that board, I thought this is bad. And I was watching on a mobile phone trying to zoom in. And when I zoomed in enough and saw the figures, I thought this is actually really like bad news.
Well,
Rich reckons that the board is from a cafe somewhere. He's seen some cafes with that board. It's like a price, This is how much your bacon butty is going to cost.
And you can get out the numbers quickly and change them when inflation creeps.
Yeah. Or like I'm cross with this particular country. I'm going to slide that out and put a new figure in.
It was like that in Argentina with the menus. There was like stickers on all the prices where they'd stuck over because the inflation was so high. They're constantly changing prices.
Yeah. Speaking of which, we've got loads of people on the chat. Producer Phil, if you can put up, or Cam and Terence, because I don't have that nifty button thing, which is way over there. I'm going to pull it round. If you see me reaching over, we've got this. Soon Rich and I will have one each, but we're sharing one at the moment, a Stream Deck, so that we can punch the buttons. I know I'm not being paid by Stream Deck, by the way. This is not product placement, but it's cool because we can now punch up the screens. So we got David Boyce chiming in. Good morning, Boyce, the voice. Kate Murphy, welcome. I saw your question earlier. We do have some classes from time to time, so keep an eye on the chat, or we'll let you know when the next one is coming up. We also have key events, of course, Tasty coming to town sometime in the summer, and so you can get tickets to come to those if you're a beginner in the option side of things. Rich and I definitely be there. Monkey Man asking, how is the coffee intake today? Well, Aaron, you know that I've been trying to cut down my coffee. Maybe you can tell them how. Yeah, you're on your one already. I haven't had mine today because I've been told to keep it to one. Aaron, you can tell them how I am. What is Ange like after I've not had coffee?
Terrifying.
I get very grumpy. US Treasury Secretary Scott Bessent, Neil here chiming in, saying that Bessent wants to lower the yield on 10-year treasuries. And boy, is it working? I mean, woof.
I think we spoke about this a while ago where there's this sort of conspiracy that they're engineering a downturn to get a fall in yields, which would be quite something. A bit of a conspiracy theory, in my opinion. I don't think the US president wants to crush his own economy, but who knows?
I mean, it's a good one because it does seem to be, it's yields. I just talked about it earlier, heading that way.
It's from a multi-asset perspective, this is wonderful for me because I'm so used to, the past few years, used to basically a really high correlation between equities and bonds. And now we've got this classic inverse correlation, which is amazing when you're managing multi-asset portfolios. Because as we were saying, when the yields fall, it shows that the price of the bond is actually going up. So when the equities are going down, the bonds in our portfolio are sort of helping offset these losses, which is basically... that's what we're meant to be doing, and it makes me happy to see some green in times like this. Yeah,
which is why we talk about diversification all the time, right? Essentially, what you're saying is like the levers are now starting to work like they should again.
Yeah, it's really refreshing because we've got that lower inflation. It's not incredible inflation. It's still like that 3-ish%, but better than 11. I mean, I will certainly take 3% inflation over 11% inflation every day of the week. And that's why you're beginning to see the sort of typical equity bond sort of relationships come into play when you have volatility.
Yeah. And also Steve Davis chiming in. Thanks for pointing that out to David. Yeah, Axel and I have been talking about this recently, about, cutting your losses. You can leg out in a calm market. And if that helps you leg out or exit that trade, then do it. But in these sort of markets, this is the caveat here. When we're seeing this much volatility, you need to just get out, right? You just need to get out, rethink your position, and then think of when you re-enter, because this sort of volatility is very rare. Even for us that cover markets every day, you know, the last 2 sessions have been, you know, something kind of like a hurricane hitting London, for example. It's
we haven't
huge
seen this sort of moves
for
in
a
5 years.
long time, for a long time. So let's talk about, you know, we talked about diversification and everything. Lots of our trader friends asking, you know, how if we want to, like, we got cash on the sidelines, we want to go shopping, and where do we put the money right now? Well, so I've looked at some defensives for you. You've heard me talking about utilities and pharmaceuticals early in the week, but I know we have a lot of people liking retail in this time, which is to me quite interesting, because if you do want to choose a retail name, try and go for the happy middle, right? It's just like when you buy property in bad times.
It's an interesting one, because some of the defensives aren't doing so well because they're really tariff sensitive. So
Yeah.
Walmart, even Nike has got an element of defense to it. I mean, it's had a really torrid time because they're just liable to these price increases. They're facing increased costs, which is
Totally.
ultimately weighing on earnings. And that earning growth is the key driver for equity valuations and equity growth.
Yeah.
And when you put a spanner in those works, you get a lot of red, unfortunately.
Yeah, which is why that leads me nicely to my next point. People need to eat, right, Aaron? People still need to eat. Everyone still needs to, you know, whether you like it or good times, bad times.
Even after last night, you still have an appetite.
Even after last night, I bet some of you away with numbers saying, Angeline Manpain, we're talking about Elliot's, he thinks he's got gout now. I told him to do the 2 wine test. So 2 glasses of red wine. If your shoes, you're starting to feel tight and your feet hurt so much that you cannot sleep, then that's gout, right? That's an easy test. So red wine, 2 glasses, easy peasy. But grocers for food, always go to the middle ground, right? So Kroger is kind of like that name that everyone has to go to, and it's kind of like it's not super cheap, but it's not super expensive. So you're going for that safe middle. Another one that we were talking about earlier is, does all this now mean that China is looking attractive, and also several emerging markets? We had questions yesterday asking, how do we diversify into some of these other markets in times of great uncertainty, with all things related to the US economy? So taking a look at Crane shares, this is the Chin. We talked to Xiao Lin yesterday, didn't we? Aaron, do you want to take us through some of the key points?
Well, it's a really, I mean, this ETF here is a very tech focused. I mean, it's in the name, China Internet. It's, you know, got your e-commerce giants, Alibaba, Tencent, those sort of companies, which add some, I would say, some interesting flavor to your portfolio if you sort of buy this ETF. But I think with this one specifically, and when you're investing in the Crane shares products, the Chinese ones, obviously you have quite a high degree of idiosyncrasy just because you're investing in one country. So that's something to be wary of, and it's different to the US with regards to sort of its relationship with others and its sort of status on the world stage, I guess you could say. But yeah, we had a fantastic chat with Xiaolin Chen yesterday about sort of investing in China and what China's doing, how it's trying to sort of insulate its markets in terms of looking for other trading partners if the US is hit with tariffs, and also growing its sort of internal industry and internal consumption, which has got a huge growing middle class. And yes, they're trying to sort of alleviate the tariff pains. So it could be quite an interesting area.
I mean, what's also key is that, yes, China still has issues. Yes, they have, you know, this property market weakness there. Xiaolin, though, who heads up all the business outside of China, saying that they think it's now going to be she thinks it's bottomed out, and that the government has only just used some of the initial levers to help the property market there. So let's have a look elsewhere.
Yeah, that is an area to be wary of. That property market is just how levered and bubble-like it is. So that's, I guess, one area where you've heard it really from the source. Shaolin is a Chinese expert, so that's an area which to be wary of.
Yeah. How much time we got? Sorry, I couldn't hear you. Okay. Aaron, stay with us because we're going to head into week ahead next. So all you trader friends watching, whether you've got gout or not, do stay with us because we're going to tell you it's not just about jobs, but next week is going to be extra special because we've got tons of things coming up next week. We'll tell you which are the key trading events after this. Hey, welcome back to Week Ahead with myself and Aaron here. We're just talking about diversification earlier. Next week will be a huge week as well that will allow all our trader friends to diversify because, first of all, I guess let's start off with the elephant in the room. We've got jobs later on today. So that...
Well, it's taken a bit of a backseat.
It has. I mean, like, I was just talking to Chris earlier on. It's almost like an afterthought. Now everyone's going to be watching JP, right? We're now looking out for what JP is going to say.
I mean, you're always on the fingers on the pulse when it comes to non-farms, but it's like woke up this morning and I was like, oh, I need to have a look at what's going on in markets today, and then it's like, oh, jobs day. Completely forgot, off the cuff, really, just because of the volatility we've seen in equities, which has been non, I guess you could say traditional, because it's true to a Liberation Day tariff speech, which I don't think we've ever had before.
And it's we were discussing what kind of questions might JP be asked later today, and we thought, wow, he's going to be surrounded, by, they're not going to be towing the line. A lot of these are going to be, journalists with lots of wacky questions. Chris even said, tongue in cheek, perhaps maybe the first question will be, what do you think of Trump upending the US economy? And also it's going to be very tricky for him to answer those questions. It's almost like a tightrope, isn't it?
Yeah, and it just depends to see how politicized the questions are and the political views of who's asking the questions. But yeah, really, really interesting to see what he says in terms of the state of the US economy, because Jerome Powell has this exceptional power to move markets, a bit like Trump, and we've seen that over the past few years, based on his speeches in terms of interest rate projection, in terms of whether we're going to see initially whether we're going to see hikes, and the projection we saw for hikes in inflation, and now it's obviously more geared towards cuts and the state of the US economy. Obviously you've got tariffs which have now been added to the mix, so he's got a huge job on his hands to basically, I guess, try and calm investors' nerves, but he also has to be honest with what he sees going on. And look, I think from a initial perspective, when one thinks of tariffs and you see the figures, even on countries such as Vietnam, which a lot of American manufacturers use Vietnam to make goods, and now they're facing increased costs. There might be issues in terms of now wanting to relocate, and look, the whole thing in general is just going to cause higher and higher costs. And Jerome Powell needs to be quite frank about that, to be honest.
Yeah. I love the memes from last time where he was like going, I'm not leaving. It comes at a time, I mean, let's be clear as well. I mean, we feel, or rather, a lot of the analysts that I've been speaking to, and also across the floor here, usually when you have these moves in terms of tariffs, it's towards an end. This time around, it feels like no one really knows what the end game is. Andrew McKilvey chiming in, saying, first question to JP, is Liz Truss advising the White House now? It's a worthy question. I mean, let's have a look at some of the crazy statistics, right? we're seeing, and this is from Politico, 1890s levels of protectionism. This is what we're seeing right now. You know, this is the biggest one-off tax hike since Lyndon Johnson's drive to fund both the Great Society and the Vietnam War 60 years ago.
I can't say I personally remember 1890s protectionism from personal memory.
Clearly, our young Aaron here does not have gout issues.
Not yet.
Very useful. Not yet. So, and this is all being implemented like that, right? It's just being implemented like that on a restaurant menu. Lots has been said about, you know, like JP Morgan saying on a static basis, the tariff announcement will raise just under $400 billion in revenue. That's just 1.3%.
That's assuming that the level of trade continues at a high level, which, you know, is a bold claim, I'd say.
Exactly. Monkey Man saying, I heard Nike has 14 factories and employs 500,000 in Vietnam. Definitely. I've got Nike shoes that say made in Vietnam.
Yeah, they're all made in Vietnam, yeah.
I think Skechers is made out of Vietnam as well.
Yeah. My dad was in the shoe business, so he used to go to the Far East a lot to visit factories back in the day. So, yeah, interesting.
And I think it was maybe away with the numbers. Someone on the chat cleverly said, you know, yesterday that actually these companies, they didn't have a gun to their head and weren't told you have to outsource. You know, they outsource for a reason, right? They outsource, of course, yeah, for a reason. And
if they can get high quality goods at, you know, I don't know, 60% of the price, it's sort of a no-brainer for these companies who are looking at their share price, looking at their earnings growth and saying, well, what can we do to boost margins?
Yeah. So, I mean, the question now is whether you sit on the side of the fence where you think things are going to get better because this is just a stick and he's going to get everyone to the bargaining table. The tariffs will be rolled back or tweaked somehow so that, you know, growth doesn't get completely derailed. Or you think that you agree with the likes of Ernst & Young chief economist Gregory Darko predicting stagflation, right? So we've seen this before. We've been here before. You know, this toxic mix of low growth and inflation. And this would essentially push the US economy into recession. Of course, we know if the US hurts, then so does the rest of the world.
Totally, yeah.
Which side are you on, Aaron?
I think that there's probably going to be a little bit of pain. Look, if you're facing increased costs and you're a business, you're going to pass it down, which is going to lead to inflation and economic pain. So yeah, the stagflation argument can hold a little bit for sure. But if what Trump is obviously trying to do is trying to boost American home production, and if he can do that whilst keeping prices relatively low, then we can avoid recession potentially and higher costs. So that's the balance that he's trying to achieve. At the moment, I'm probably a little bit of a pessimist just because I think the world has become very interdependent on other nations for cheap goods. And when you put a tariff on that, it just hampers the whole sort of system that we have in place at the minute.
And speaking of which, the other fascinating thing that has come out from all this is the last time we were in this situation with Trump 1.0, had lots of CEOs coming out vocalizing how they felt about his policies. This time round, have you noticed, Aaron? Not many CEOs, in fact, none that I can of note that have come out either saying yay or nay. It's just complete silence out there. In a time, just whacking up my screen for you, in a time when we are seeing billions, right, wiped off some of the biggest US stocks here. Taking a look at the chart on my right-hand side,
On
put
Bloomberg
together.
last night, they had two guests. One was the governor of New York, who's a Democrat. One was a Republican congressman from Tennessee. And it was very interesting to see the differing views. And obviously, New York has got a lot of agriculture. I think there's something like 20,000 farms in New York, because obviously it is more than Manhattan, and they're going to face increased costs. I think the farmers there are expecting to face increased costs of something like $10,000 a month. But alternatively, the Republican congressman from Tennessee was saying, well, we've been bullied by China for so long. We need to bring back American industry. We need to ensure American jobs, and was very pro-tariff. So that is, I guess, the argument. And I think there's elements of both which can definitely come to fruition. But look, we're sort of used to this sort of cheaper environment. So I think there's going to be definitely concerns if things go up a lot in price.
So let's just give our reminder to our trader friends what is key in the coming week. We've got on the macro front FOMC minutes, but we also have the CPI figures. FOMC, of course, will be overshadowed by what JP says at around 4 something our time later today. I think it's 4:30.
Yeah.
We've got US CPI as well in the coming week. Of course, this is backward looking. Things have changed dramatically. Every central bank highlighting risks to the upside for inflation right now. And of course, we might hear more on the tariff front in the coming week. Anything else on your macro radar, Aaron?
Well, I think it's just continued policy developments we get from this sort of tariff thing, this whole tariff liberation movement thing. So, seeing how world leaders react, seeing who comes to the negotiating table, and seeing really what markets do based on what they're seeing at the moment and what they are preempting.
Just looking to the earnings side of things, now in the coming week, we have Delta coming out with earnings, Tesco as well. And of course, the back half of the week, the main key event. This is the start of the party. This is the pre-market party, always kicked off by the banks. We've got JP Morgan, Morgan Stanley, BlackRock and Wells Fargo, and not forgetting BNY Mellon as well. Just showing you the Delta airline shares here. Currently, this is all sessions on the IG platform. Of course, you can take a position right now and express your view. Down 0.5% there, but it has had quite a leg down, as you can see. Many out there now questioning whether or not the airline industry is going to either benefit from lower oil prices, or indeed is it now all to do with consumption and demand. United as well. Don't know whether you saw this last night, Aaron. I'm going to punch this up for you. United Airlines. Look at that fall.
It's incredibly sensitive to the state of the economy, these airlines.
I know, down more than 12%. Bearing in mind, this is United Airlines, people. This is not a biotech. This is not a fintech. This is a solid company.
But it's important to note that the equities, the sentiment was so strong and the valuations were so high, obviously mainly for the tech companies and the Mag 7 and whatnot. But when sentiment switches like that, that's why you're seeing these big moves, because it's like, the party's over. Then you get the rapid sell-off in all areas, and people will sell these cyclical companies because by definition, these companies go through cycles. And if we're poorer and everything's more expensive and the economy's in turmoil and people are laid off, they're not going to be buying flights.
No, that's exactly right. And so there's your answer, Andrew McKilvey, because he was asking whether or not it's time to get into IAG. It's important to note that the pendulum has swung, and actually It's always important to know what's now driving the mood music. We're seeing, like Aaron said, widespread. It's not just United, but Delta you saw was down, JetBlue down, American Airlines at one point, I was checking, down almost 7%. These reciprocal tariffs is going to make everyone feel, if not be poorer, if they don't somehow or another get resolved or roll back. And we are seeing this translated into the valuations of airlines at the moment. How about banks? Any insight on the banks and what their earnings are going to look like, Aaron?
Well, I think with banks, it's an interesting one. Obviously, you have rates which are coming down allegedly. I mean, they might not come down at the speed we have envisaged. But I think there's concern over potential delinquencies, defaults from consumers. We've seen record levels of credit card debt. Probably post 2023, we started seeing that 2023, 2024. And look, we have all this tariff woes, we have all these increased costs. You're going to get increased defaults, delinquencies, mortgages not being paid. And that's why I think you're seeing this sort of, again, fairly cyclical move in the banking stocks.
Yeah. And just checking the banks as well, because JP Morgan Chase down, Bank of America was down. They're all down, extending declines after Trump's announced reciprocal tariffs there.
It's the same with the corporate and investment banks as well. I mean, if I was a CEO of a company, I probably wouldn't be looking to conduct M&A if the outlook in the area was bad and we were facing concerns over earnings.
All right. Well, just a quick reminder, everyone, to like and subscribe. Thank you so much for, being with us on this journey, being with us on the show, and also coming with us to the new site. Any of your friends, like-minded friends, wanting to find us, parents, mothers, I'm sure fans of Ronnie, please share the link and get them to watch us. You can always put your comments on the left hand side and also at ask@ig.com, but subscribe and like. Monkey Man asking, anyone here that British farmers are going on strike for wheat? We will find out for you, and do join us on Monday, because I would like to, I've already been planning this, so actually it's very present, Monkey Man, looking at an agriculture play, because Issa on Thursday, or was it Wednesday, gave me an idea as to how to trade soybeans and agriculture in a time of tit-for-tat tariffs. We'll see you then. Have a good weekend.
Take care.
Oh, we're back. It's Thursday, April 3rd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, as we take you through the rest of this trading day.
So is the new April Fool's Day the 2nd or the 3rd?
We find ourselves in a predicament here. If you're joining us on the platform, if you're watching us on tastylive.com, welcome. If you're on the platform, come over to YouTube, join the conversation. Tell us what you think of what's happened here over the past 24 hours. If you've been following me today in Futures Power Hour, if you've been looking at my Twitter feed, if you watched the show yesterday, you've been witnessing a slow descent into madness. So I hope you've been enjoying it. The markets are enjoying a slow descent into madness, or perhaps not so slow. Stocks fall out of bed after the tariffs were announced yesterday in one of the most sloppy and ridiculous fashions that could have been done. To all the people out there saying that I'm just a professional managerial class coastal elitist who's upset that stocks are down, you don't know me. That's not what I'm upset about. I'm upset about how this is not going to help any of the problems that we're stating to actually go solve. It's going to make things worse. Mm-hmm. But the market hasn't fully.
Can we talk about that? Can I just go right there?
Sure,
can I make a recommendation from the peanut gallery?
As you were.
There's no shortage of criticisms and obvious critiques to be had here, and there's no shortage of, trading issues to reflect upon. Obviously, recession probabilities have gone up, all the things. But let us just suspend all judgment for a moment and presume that the President of the United States is correct in his desire and his efforts to return manufacturing to the United States of America. He does not work for the financial class. He does not work for the investor class. He works for the forgotten American worker who was abandoned by NAFTA and abused in the financial crisis. and is now bringing manufacturing back to America at the expense of the Wall Street fat cats. Why is he wrong? Why? Not why is he wrong? Because I mean, there's 1,000 wrongs. Why do you think that? Do you when you say he won't get what he wants, do you think that this will not help the lower middle class American manufacturing worker?
Well, right off the bat, today we have job cuts announced in the United States with companies citing the tariffs specifically. Maytag is shuttering a factory in Iowa, about 600 jobs. Stellantis is closing down a factory, idling a factory in Michigan, a few hundred jobs there as well. They're also shutting down plants in Mexico and Canada as they work through the supply chain issue. I don't know if people recall one of the frustrations of the Biden era, which was they spent all this money to build infrastructure, to electrify the grid, to connect transmission lines, to put charging stations everywhere, and it became a running joke that they couldn't accomplish a single damn thing because there was too much red tape to go through. And of course, you ascribe this to a deliberate waterfall process. If you talk to any policy experts, you can't just move on from stage one to stage two of the process until all of stage one is complete, and it goes on a state-by-state basis. So once it happens, it's going to happen all at once, but it took a long time. That is the same problem right now that the Trump administration has, because the continuing resolution that they just passed a few weeks ago extends the laws that were set forth under the Biden White House, which means all of the bureaucratic red tape to laying new infrastructure and building new factories remains. And we now find ourselves in a problem where we have these multi-year review processes, if it's NEPA or any of the other widely abused bureaucratic overreaches that are intended for good purposes, protect the environment, ensure that people aren't screwed when a factory moves into town and gives all their kids asthma. We're actually, those processes have been abused and we're not building things anymore.
So you're saying that
the real risk,
the Trump voter, that the alienated Trump voter shall not be served?
Not in a timeline before there is an immense amount of pain if the results do boomerang back to us. It takes years to get a factory built and open here in the United States. It's not something that happens in just a few months, particularly if we're thinking about the supply chain critical issues like the semiconductors.
Can I just say, like, forget building a factory here? I mean, no, forget it. But just like, yes, obviously all the obvious issues with building a factory here. Now I'm going to argue against myself here, but whatever. I'm not even making. I'm just exploring. I'm just trying to find some path somewhere for somebody.
I have a path here. Like, there is a way to do this. Doing it in
There's a way to do what? There's a way to do what?
Reshore manufacturing jobs.
Okay.
And it means an entire overhaul of the entire tax code. It's not an interesting topic. I've joked here before. I get a copy of the tax code every year from my mother because she's a tax attorney, and that's not a joke. I get like a 50-pound bag of pistachios and the tax code because we do white elephant. I'm like Atticus Finch getting paid out here. All right. We need to change our tax code to a destination-based taxation system. All right. I spoke about this on Futures Power Hour earlier. One of the core arguments for destination-based tax, especially when paired with something like a border adjustment tax, is that it can incentivize the reshoring of manufacturing. Under our current system, the U.S. producers are facing a double whammy. Their goods are taxed when they're sold domestically, but imports competing with them often enter the country without equivalent taxation, especially if they come from countries with VAT systems that rebate taxes on their exports. So that creates a structural disadvantage for American-made products. A destination-based system flips that script. Why? U.S. exports aren't taxed, so American-made goods are more competitive abroad, and imports are taxed at the point of sale, making foreign-made goods less artificially cheap in the U.S. And so those incentives shift there. If you're a manufacturer deciding where to produce, a destination-based system removes the tax-related penalty for making goods in the U.S. It rewards domestic production because you're no longer competing against untaxed imports. It's not the silver bullet solution. You have to think about labor costs, regulation, supply chains, but this helps tilt the field back towards neutrality. And with a destination-based tax system in place, with some sort of balancing equation, like if I could have a plant here in America or have it in Vietnam, if I want to have it in Vietnam, the taxes will need to be geared in a way that accounting for transportation, security, warehousing, et cetera, overseas, it would just make sense to pay American workers to do it here at home. You have to level
some of this logic
the field.
is in the reciprocal tariffs, by the way. If you look at the
it's kind of in there. It's kind of
if you look at it, right, the tariffs on South American countries are all at the floor of 10%. Right. The tariffs on Southeast Asian countries and China are much higher. It does seem like there is a thread here that says we're going to move manufacturing from China somewhere. And where we want you to reshore is the Western Hemisphere, because the new Monroe Doctrine is the operative sort of way of thinking. And that's not a bad goal in and of itself. In fact, it makes quite a lot of sense and sort of factors in with the idea that when you renegotiate the USMCA, which is the whole kerfuffle with Mexico and Canada, if you look at the history, first Trump administration would tear up NAFTA, say it's the worst agreement ever, then sign the USMCA, which is nearly identical to NAFTA, but a little bit broader. So we end up with more free trade, not less. Now look at what's happened here. New tariffs on Mexico and Canada, except everything that's in the USMCA is exempt. What's the incentive there? Make a bigger USMCA, more things are exempt. Again, more free trade, not less. The building of a kind of Monroe Doctrine, we are the Western Hemisphere house and no one shall come into the house, that, and we want to reshore everything here within our immediate sphere, all of that is here. The problem with all of this, to put it very simply, and I think, Chris, this is where you're going, but in my mind, it's like third grade logic. There are more people that use steel than make steel. This is what we learned in the first round of these tariffs in Trump 1. When you do this with this instrument, you hurt more manufacturing than you help. It's really that simple. It doesn't need to be any more complex. This is free trade in reverse. If what free trade does is help most
American
people,
Brexit? Is this a version of American Brexit?
This might be more foolish than that. Because what this does effectively is this says, if free trade helps most people but hurts a minority, and the object is to help the minority, then what this does is it hurts most people but helps a minority. And now you have a very big issue to solve rather than a smaller issue. Moreover, if the markets were afraid of tariffs as such, we would see this in November, but we didn't. This is not about tariffs as such. It's about the implementation. And what the president has done here is unveiled a bilateral schedule of tariffs. This is an opening bid on a renegotiation. It's going to take forever to negotiate each one of these individually. What the market wanted was certainty. This is the opposite of certainty.
It feels like there's a lot more uncertainty, and I can't, I'm trying to place my finger on whether or not the market is upset about the tariffs themselves or the methodology by which they were derived. Because when people were looking at the tariffs, when Trump was up there with his, little whiteboard yesterday, his chart, people were wondering, where are these levels coming from? And this really begs the question, or how are they approaching this in any sort of rational way of thinking at all? Again, I've had plenty of complaints about it. Just check my Twitter feed. I don't need to air them out here. But it completely ignores our service exports to the rest of the world as part of these calculations, right? When we're making stuff and selling it abroad, people are going to complain. It needs to be more than bits. It needs to be atoms too. We have to have real tangible things, not just software. But all these calculations are done from cherry-picked data that kind of don't line up with any sort of conventional or unconventional thinking about how to approach trade. and all of our allied nations, all of our friends around the world who we do significant business with are saying like, none of this makes sense. Like we have to protest this at the WTO, as Japan said, or we're gonna just hit them back because we can't argue or deal with this right now, right? We're not. Is this a negotiating tactic? Lutnick is out with a bunch of different things today. Our favorite cabinet member here on Overtime. Let's look at some select quotes. No chance Trump will back off tariffs. Negotiating is talking. No talking, just doing. Trump will stand firm. The way that countries can get this to stop is to stop exploiting us. It says if the dollar's cheaper,
you have to say all these things.
Export, but we don't have.
Otherwise, it's not the cudgel that you want it to be. There can't be a negotiation if people think you're not serious.
Right, and Mark Carney, though, today says the integration that Canada has with the U.S. over the past 80 years is officially over.
Right.
So realpolitik.
That's his pitch to get elected
to voters.
I mean,
to get
obviously
elected.
That's not real.
That's his pitch to get elected, which means he's not going to back off that rhetoric either for the next little while.
No.
Sounds like that the market is still thinking that this is going to be walked back sometime soon.
It's not enough.
I mean, that was the next place I was going, was like, is the market's response today actually still a heavily discounted perception of the actual probability of the real implementation of actual tariffs? In other words, if these tariffs were really the numbers that were thrown around, would not the market be down more?
I'm going to go back to my favorite broken record, which is to say that what the markets do when fiscal policy makes no sense and is counterproductive is they turn, as Princess Leia in the opening of the first Star Wars movie might, to Jay Powell and go, help us. You're our only hope. The Fed is our only hope. Give us the cheap money that will be the shock absorber to all of this. And the markets, I don't think, are prepared to do the full capitulation because we have NFP tomorrow and Powell speaks. And we're going to see if he comes out and goes, okay, everyone, here we go. The ISM data today was awful. It showed the U.S. service sector basically ground to a standstill. So, and by the way, the worst part of it was a collapse in employment within the service sector. New orders stand still, okay, people are unsure. The price structure high, okay, we've known that for a while. Employment is actively shrinking in both the service sector and manufacturing at speeds we haven't seen in a very long time. And that's maybe going to show up in NFP tomorrow. We'll see. NFP might be a little lagged. But to the extent that the numbers give the Fed clearance to act and Powell comes out and says, okay, it's go time, the markets, I think, are prepared to kind of greet that. But if Powell comes out tomorrow and says something on the order of, well, we told you already, we're waiting to see what these tariffs actually do. We have our assumptions, but we need to see what's what, and basically sounds wishy-washy and doesn't have a sense of urgency, well, then buckle up.
Dylan, when you look around the market today, you see everything growth-related is slammed. Oil killed.
I am so annoyed at oil. I got short. I got shaken out of my short. Now I'm looking at this. I'm like, what? Damn it. It's down over 7%. I would have been swimming in oil short winnings.
But what
Instead,
if Wall Street is right that
loss.
really this is still Trump drama and that this is a buy the dip? How about the other version of this, which is that none of these tariffs will actually get implemented? There's going to be a whole wave of deal making the next week to recut all these deals, and things are going to ultimately normalize, not become chaotic. That the
if
Trump
Powell
administration
comes out tomorrow and does the Draghi, I can see that.
Would you buy oil? Would you buy
I would not.
Tesla? Would you buy the Russell? Would you buy the
I
Nasdaq?
would get out of my shorts. I might get out of my shorts. It depends, obviously. It depends
You're
on
saying
the
you might
market
get out of your
action.
shorts contingent on a Powell accommodation narrative.
Contingent on how the market responds to that kind of a narrative. It's all about the price action. If Powell comes out tomorrow and says, look here, we will do whatever it takes. We have all the monetary ammunition we could possibly imagine. Rates are high. We've been doing QT for a while. We'll turn this car right around. We'll give you a bunch of cuts. We'll give you a bunch of QE. We're not going to do it right now, but just so we're all clear, our finger is on the trigger and we're ready to pull. I think the market is going to unclench.
You know what the worst part about all this is? Is that the dollar didn't strengthen today.
I think that reflects what the market wants, which is easing.
I see it reflects a group of people overseas selling their equities, taking their U.S. dollar denominated capital, converting it back to their home currency.
That is surely a part of it.
And that just scares the hell out of me. That's not what we should be
That's
seeing.
surely a part of it.
That's what's happening, man. That's what's happening, brother. That is what is happening.
Because I mean,
People are like,
European
okay,
indexes are down also.
Holland.
It's not like this money is going into European assets or APAC assets. Everything is down today because obviously a trade war is bad all around. But to the extent that U.S. markets have outperformed and international investors are pulling capital out of it and repatriating it into home currencies, that is almost certainly a part of this dollar sell-off. But so is what's happening in ZT. Just take a look at the front end of the curve. The markets have priced in 88 basis points in cuts this year. They're basically front-loading everything the Fed said is going to happen through the end of next year for this year. Markets want cuts.
Markets want cuts.
Only
Not
reason
sure
the
they're gonna
markets
get 'em.
don't get cuts is inflation, right?
Well, that's
And
the whole
Only
thing.
reason.
All of the
That's the whole
major
thing.
forecasters came out today and said we're projecting inflation returning back towards COVID peaks and growth falling off anywhere between 1% and 3% in the second half of the year. That's kind of
And
like
look
the
at
median
break-even
point.
rates. They're up.
And yeah, inflation break-even rates have
I
gone up
hope
today.
that isn't true. I just hope that's not true.
If Powell comes out tomorrow and says, the difficult balance, the risks to our mandate, and it doesn't sound like he's got his firefighter hat on, then what we're seeing today is a light prelude.
Maybe that's what causes bonds to pull back in. Obviously, they had a very good day today, gapping open higher, holding up there for most of the session, although 119 and 20 right now. Maybe that's what causes bonds to pull back. That Powell says, we got to see how it plays out. Our hands are tied. Isn't that the risk here? That we don't have stepping stones to get from point A to point B, that we're doing this overnight? I mean, the speed with which this change is happening, I think, is so noteworthy. Jim Bianco, who is very open-minded about giving the Trump administration a lot of leeway here with what they're trying to accomplish. He has not been critical to the degree that I have. The three of us have, right? He's certainly not in Tom's. He's probably more in Victor's way of thinking about this. This is the chart that he shared yesterday, talking about just a shock to the system. Jim Bianco of Bianco Research. This is where our tariffs rate are, and this is how quickly they're shooting up to levels that we literally haven't seen since the 1910s. This is in excess of Smoot-Hawley and the Great Depression, right? This is a shock. This is a supply shock to the system. This is a self-induced shock to the system. It's not like this is a graduated thing. We're going to be moving to these tariff rates over the next year, and we're starting off with a 5% bump, and every 3 months we're going to move them up another quarter of the way. And that way, if in 12 months you're going to be at the 100% level that we're threatening you with here today, so you have some time. This is a
Moreover,
is a
it's not
shock,
legislation.
Shock.
It's executive fiat, which means you can't trust that this stays.
It can be undone. That is also the big problem here. that if you're a company, if you're Nike with your 550,000 employees over in Vietnam, which was wild to read about today, but their share prices fell out of bed by 14.46%. If you're Nike and you see that this is done through executive fiat, do you move your factories back to the United States? Do you switch operations to perhaps a Latin American country where you already have some factories and you ramp them up there? Why would you bring them back to the U.S.? Because odds are these could be undone.
Congress is already starting, right? So Congress is already starting to push back on the tariffs, in this case, localized to Canada. They've gotten Republicans to vote on it to push back some of these tariffs. We didn't even have to wait for an administration change. We didn't even have to wait for midterms. First rule of politics: protect your own behind. These people understand that workers in their constituencies are going to lose jobs over this. Congress is already starting to undo it in bits and pieces and fits and starts. So besides the fact that you now have a bilateral negotiation with everybody from the European Union to Botswana, you also have the inherent impermanence of the regime. First of all, because the president has shown a capricious nature. Things are on, things are off, things change all the time. That's one issue with executive fiat. The other thing is the next executive can easily undo this. And of course, the third more immediate thing is that Congress can undo it and is starting to undo it already. So if you're a business, why in the world would you change anything on this basis?
Dylan, you would probably remember better than I do. Tell us about how TARP 1.0 and Congress's inability to solve the problem quickly resulted in the market melting down more. And I ask you that because it feels like there's a parallel here. If Congress only acts in fits and starts to remove this piece by piece, this feels like this is a TARP 1.0 situation.
What you're getting at is, for the financial crisis in 2008, it was not until there was a catastrophic, unlimited intervention by the central banks at every layer of the market, from commercial paper, long end, short end, high end, short end, tall end, any end. And as long as there was incremental intervention of any kind, it only catalyzed much more severe selling, which I suppose is what you're kind of getting at.
Because then it says the thing that we just did wasn't enough.
And it says that the people in charge don't even understand what the F they're doing, as evidenced by the fact that they're taking these incremental interventions.
It just comes across as weak and indecisive.
Weak and incompetent.
If Congress is going to act to stop this, Congress has to do it in one fell swoop. It can't just pick and choose, otherwise the selling continues. But hey, you know what, Ilya?
This is the uncertainty we're talking about.
We to ride Elliott wave theory. A, B, C. 17,300 becomes your target in a NASDAQ pullback. S&P 500 now down 5.12% here, still falling after hours. A, B, C, 5173. Equity markets could still have some flush to them. I think that's what also alarms me about today. You look at the flow on the tape, we barely got to a 30 VIX by the end of the session. Barely.
Technical damage is not nearly enough to say that what you've had is a capitulation low. This is not capitulation.
This does not feel, in my personal experience, granted not as long as others, but it doesn't feel like a low right now.
Just look at July of 2008. Everybody likes to talk about Lehman. Oh, Lehman. Lehman was the crescendo, not the start.
We felt more, by the way, on Lehman Monday than we felt more today than we did on Lehman Monday, if that is of any interest to anyone.
And that was just beginning of a process that ultimately was the crescendo, and we didn't really bottom until February, March of 2009, and we were selling long before then. Go to something like a mid-July of 2008, and what you find is that the process is just warming up at that point. The euro, for example, peaks out on a test of 160, and then it's mid-July that the markets go, the world is ending, cash out everything, and the dollar starts rallying. Months before Lehman. We're just getting started here, if this is how this is going to go. This is an appetizer.
Oh, yeah, this could get a lot worse.
This could get much uglier.
Yeah, Dylan, you asked the question at the start of the show: is Wall Street still swimming in a sea of, its own nonsense, that it really hasn't fully priced this in yet? We've come 10% off the highs.
I was just sort of conjecturing that it's like, if you buy the rhetoric, which is Trump doesn't care about Wall Street, Trump's working for the working man, and it's screw Wall Street. It's high time finally a president worked for the working man. But the issue is, I don't find that to be credible personally, because I don't see the benefit to the so-called working man from any of these policies. I see it through the same lens as Brexit, but to your point, maybe worse. And the other thing is, it's all political. So I also think that there's an incentive for the Democrats to stand out of, like, when they're one of many sort of saying, I guess, but when there's a runaway freight train, the best thing to do is step back, get out of the way, and let it hit the wall. And so there's an incentive for the Democratic Party to do nothing right now.
I think that's awful.
And let the Republicans do as much damage as humanly possible to the global economy and the American economy, because it's in their political self-interest in 2026 for the American economy to be a catastrophe, even if that's an abdication of their responsibility to be a custodian of the people of America. And that the Democrats, I believe, are just as willing to sacrifice the people of America for their political self-interest. Furthermore, the only reason Donald Trump is the president is due to incomprehensible incompetence on the part of the Democratic Party in their inability to actually run a normal primary and field a presidential candidate who could have credible standing in the electorate, which they refuse to do, which is the only reason, in my opinion, why Donald Trump is the president in the first place. And now the Democrats basically allowed a fruitcake to become the president, and now they're standing out of the way to let the fruitcake run the fruit train straight into the wall so that they can then get political advantage in 2026 without any self-reflection as to what it says about them that the American people preferred a fruitcake to what they were offering.
Let's go to the great book, Geopolitical Alpha by Marco Papish, where he talks about this really great concept called the will of the median voter. And what he talks about is this idea that even in non-democratic countries, leaders, lest they want pitchforks and torches on their doorstep, have to kowtow to some extent to public opinion. They have to give people at least the appearance that they're doing the thing that the people want. We obviously see that not just in the US, but internationally. There has been a backlash against globalization. There has been a backlash against immigration policies. There has been a backlash against China and the sort of free rein that it was given with its admission into the WTO and sort of everything that followed, the sort of aspirational perspective on China, saying, well, let's just give them the access now, and that will discipline them into international norms, rather than let them first become disciplined to international norms and then let them in. Not unlike the absorbing of Portugal, Spain, and Greece into the Eurozone before they were ready. A sort of aspirational move that, of course, later turned out to be a giant crisis. So the median voter has already expressed displeasure with all these things for a long time. What I think you're seeing around the world is there's a lot of people that recognized this and then a lot of people that didn't. And the people that didn't aren't winning elections. And the people that did are not sticking the landing on implementation. So the thing to do for people that want to win power is to recognize the moment, but then to implement well and in a sane fashion.
I do want to address something that just came in here over direct message. I think someone's listening right now. Chris, I saw that markets are in turmoil on CNBC. This is a very important sticking point for us here on Overtime.
Wow.
That is not true. That's
Big.
not true. That's not
big.
true. No, that didn't happen. I want to just put that out there.
Okay.
The Federal Reserve is not likely to rescue markets and economy from tariff turmoil anytime soon.
No,
that's not it.
No, that's
we need the
not
Chiron.
turmoil.
We need the PM special.
That's what we're looking for.
8 p.m. Eastern is the key.
What we're looking for.
Right? You need the big evening special. You need the Chiron. Now,
that's when you back up the truck. That's when you borrow from your uncle.
That's right.
Exactly. Right. So this is the headline has the words markets and turmoil on CNBC. That is true.
No.
We are looking for something very specific. It is this Chiron. It's this image. If you see it, send it to me. My kids' college fund will thank you.
The cover of The Economist this week, very important to look at as well. We'll see how that goes.
But why do we bring up this cover? I want to remind everyone because we haven't talked about it in about a month. Charlie Below on Twitter from Compound. Every time that CNBC has run this, period, it's been a 100% positive hit rate a year later with an average return of 40% higher for stocks.
Every time.
And not a small sample size either, like 63 occurrences.
No,
right?
No. Solid. Statistically significant.
So that's why we joke about it, but legitimately it is one of those, okay, if you've seen it ascend to this level of fear, then you're probably in the bottoming process, which
I hosted a bunch of those, by the way. I was the host of a number of markets and turmoil 8 p.m. specials, particularly in 2008. I'm just so you know, you can thank me. Your children, were they to exist in 2008, which they didn't, but if they did, should thank me for their sort of luxurious college lifestyle in the future.
The cover of The Economist this week has Donald Trump with a saw. And the tag is Ruination Day. So I'm not sure.
I like that. I saw that cover. Mm-hmm. I thought that was very
I'm not
creative.
sure we're quite there yet. I'm not sure we've kind of reached. I think we're still kind of noodling on tariff policy. We haven't
How
gotten
about that bond position, though, Spivak? You got that thing working, my man.
Not mad at it.
Beauty.
Not mad at it.
I thought of you this morning. I was like, my man in Portola is feeling all right.
Pretty good. I like the euro.
Yeah.
I like that long. That's working.
Looking good.
Well.
Looking good.
I'm also
feeling good, Billy Ray.
Feeling good. Right. Looking good.
I'm also looking with a lot of curiosity at Chris's favorite racehorse, because you'd think gold would be up, but it's not, and that kind of it's an interesting sort of thing.
I felt like people were raising capital today.
I get that sense. I was also talking.
Silver scares me. Silver scares the hell out of me, though.
I was also thinking a lot about this and how gold has basically ignored yields in the dollar in this entire run-up, and sort of thinking about gold is, let's say you have a war that breaks out, right? What happened when Russia initially invaded Ukraine, right? Gold surged. Why? How is gold a haven against Russia invading Ukraine? It isn't. But the reflexive thing is people go, I don't know what's going on. The one thing I can do is buy some gold because that's a thing I can do when I know nothing else. So if you look at then the rally in gold in the context of the tariffs, you go, well, this is like, this is a warlike response. And so now that the invasion has ostensibly occurred, you've had the reciprocal tariff announcement, you see the damage, the uncertainty of just whether the invasion would or wouldn't occur is ebbing out of it. And people go, okay, now we know that the release valve is the Fed and the dollar is going to get shellacked because yields are lower. Okay, we have a playbook here. And the playbook is chaos. If you don't have the playbook, you buy gold. If you get the playbook, maybe that part of it is over.
So today's action obviously has a very defensive tone here, as you know, can only speak from ourselves. This is more market commentary than strategy, but you know, the AI power names are really helping here, guys. That was one of the insulation points today in this market. EXC and Duke breaking out. We talk about power demand going up and potentially straining our relationships with everyone else in the world. Will power companies, because we can no longer blend power in from like Ontario, for example, would that be something that helps domestic power providers? I would think so. It gives them a more monopolistic position. So EXC here is continuing to surge. Earlier this week, we talked about putting a position on in Duke, which was the double bull, short the put spread and long the call spread at the same time. And that now seems to be breaking out after today. So these are the winners right now. I mean, that's really what you have to think. If you're thinking about a market where you're looking for some long delta opportunities, it's not necessarily going right to tech, which is trying to catch a falling knife. It's looking at what worked well today, what didn't really have that significant of a pullback in today's session. And if you have spikes in volatility in those areas, you probably can start operating on the long delta side in those individual equities. They're not going to be the sexy names, although, you know, Philip Morris, yeah, I think all of us could go for a cigarette after today. Like, this is, you know, a company where you have a 109.3 IVR, 10.6 million shares traded today, and it's breaking out to a new all-time high. So if you're looking to sell a put spread in stocks, you have to kind of pick and choose where you do it right now. And do we think in a world where, you know, there's this much stress in people's lives and the prospect of higher unemployment rates in the short term, which legitimately, maybe the tariffs work out and cause all this reshoring and all this is for nothing. In 3 years, 5 years from now, we can look back and say, hey, that was a lot of pain, but it was worth the gain. I don't think that will happen, but, you know, I want the country to succeed. I think a lot of people are going to be stressed out in the short term.
Yeah.
So owning a cigarette company seems like a tongue-in-cheek good idea, but it's a staple. It's a staple. PepsiCo is a staple that's moving higher today, right? Unlike other stocks, it's holding up throughout today's session. It has a 93.4 IVR. We can operate on the long side still selectively. I feel much more comfortable selling a put spread in a name like a PepsiCo or a Coca-Cola or a Duke Energy or an Exelon right now than I do when I look at the NASDAQ and think 5% down, this is a gift. This may be a gift if you're a long-term investor. As a trader, we have no idea what's going to happen next. And I said earlier this week, I had no conviction whatsoever. I was, you know, this is the outcome that was possible in the fat tail. This is the fat tail realized. And I only wish that I had acted on those feelings a little bit more. This kind of sucks. This kind of sucks. This kind of sucks. Dylan, what's your give us
I'm happy I bought the bond. I'm happy. I woke up today. I saw this whole situation. I'm happy that Ilya sort of pointed me in the direction of the bond not that long ago. I'm unhappy about the euro-dollar relationship just because I live a life that earns dollars and spends euros, and it's not, you know, that felt like a personal assault from the president, but, you know, we'll set that aside. I ultimately go back to a conversation I had with Angeline with IG in Europe yesterday morning, which is to sort of settle into there's going to be this is 2025 is going to be a bad year economically. There's going to be a recession. If there's going to be a recession, it will finally arrive. Other than owning the bond, what do I want to do? Which not to become sort of redundant to what you just finished doing correctly, Chris, which is okay, consumer staples, utilities, you just kind of flip through those charts. And I guess the debate that I'm having, which I'm happy to hear feedback on, is, am I better off to own more bonds and more consumer staples, or should I be noodling around with this opportunity of a lifetime to buy myself some Amazon, to buy myself some Tesla, to buy myself some Apple? The hyper growth, the Mag 7 are getting face pounded, and now's the time. And so the question is sort of, or do you do both, or how do you even differentiate between the more conservative position, which is own the bond, own staples, wait it out, and the more aggressive position, which is sure, own the bond, own some staples, but come on, party boy. Like if you want to, you think Apple's going away, you think Amazon's going away, you think Meta, Tesla, is going away, unlikely. So
Sure.
Get them while they're cheap.
I don't know. I feel like a lot of countries would be happy to use this moment to get Meta and Facebook out of their ecosystems, right?
I don't
social
doubt
media.
that, but I'm not sure that's so easy that's easier said than done,
Yeah, well, you're taking something away from people, and that's going to stink. Meta obviously has a very big breakdown here, but again, you talk about the significant technical damage, or Ilya's been, saying significant technical damage. This is falling through a lot of support very quickly. It's an area that we bounced off of just last week. Maybe that's what we need to contextualize here. Compared to last week's low, 553.30 in Meta. Today we're at, 531. We're not talking about something enormous to get a little bit higher here. Meta could move that very easily in a day or two and get back to a place where we were at the start of the week. And all of a sudden you're like, okay, what's the damage? I think that's a fault. This is a sell the rip, not a buy the dip kind of environment right now. And you can see it across the board. What did Scott Bessent say yesterday about the declines in equity markets? That's a Mag 7 problem, not a MAGA problem. That is an awesome line. That's a great line. That's a great line. It's a great line. Got to give it to him. 45.2 IVR in the mags, so volatility really hasn't pushed up here. We haven't seen it blow out. We look at the volatility futures curve right now. If we go out to VXJ, yes, it has jumped, but it's 26.4. We can keep going out. We'll go out to June, 26.38, right? You're not seeing crazy numbers here on the board just yet. 22.5 for September. We're in backwardation, but stocks don't like backwardated VIX futures curves. Mike Butler was talking about this yesterday with us, Ilya.
Mm-hmm. That's right.
How stocks do not rally when you have a flat vol curve, futures curve, or you have one in backwardation. You needed to get back into contango, and we move further away from that today. So it's difficult skis here. I guess in terms of some position management, I'm going to keep bonds on for the time being. I think you are too, Ilya. I guess there's a question of what to do with silver. Two sides of this coin. We rolled it earlier this week to get out of the way of being at 21 or 22 DTE on Friday. Good, because this would have turned a winner into a loser. This is now a loser, and there's some 80-odd days to expiration. Volatility is creeping up. I'm going to have to rest on my fundamental laurels here. That in recessions, bonds and metals are the place to hide. That served me well so far this year. It obviously sucks on this particular trade. But gold's only off less than 1% throughout all this. We talk about the gold-silver ratio blowing out. Mm-hmm. If we drop below the swing low that we had at the end of February, because we haven't cleared the March low yet, if we clear that out, then I'll just take the loss and go back to the drawing board on this particular small. It's eating dirt. I couldn't get filled on copper today either. But the long term here is if you're looking at the SI N5 contract, Ilya, you prefer your horizontal lines more than your diagonal ones. If we get down below $31.67, I'll cut it because right now it's basically at max loss. So what the hell? Might as well have it. See if we get a little bit of a bounce back. This didn't work. This didn't work for me today. Obviously, buying that 5,800 call for Friday's expiry didn't work for me yesterday. And crude oil, my geopolitical kicker, this one didn't work for either of us. But I actually want to add one more layer. We talk about connecting dots for what's happening in the Middle East right now.
Yes.
We've started to move even more assets over into the Middle Eastern theater in recent days. There was, if you guys follow OSINT, or I think his name is OSINT Defender on Twitter, he pointed out earlier in today's session, and I'm not speaking to this anything other than the fact that this guy tends to tweet a lot of military stuff, news, yada, yada, yada. He was talking about today how not only do we have carrier strike groups that are moving and relocating into the Middle Eastern region, we're going to have 2 aircraft carriers overlapping there. We also see that the Pentagon has ordered the relocation of at least 2 Patriot surface-to-air missile batteries and one of our THAAD systems, the Terminal High Altitude Area Defense System, to be moved from where? Asia into the Middle East. I'm going to roll down. I didn't do it yet. I wanted to see where we settle. I'm going to roll down the call spread that I purchased earlier as my geopolitical war hedge. I think it's a lot more appealing. I want it to be $5, $7 above where we were trading just a few days ago. So I'm going to roll this back down to like 72. But I'm feeling like, given all of the chaos that we're seeing right now in the news and some of these military assets being moved around, maybe it's posturing. But now there's 3 points of interest here. Threats over the weekend to bomb Iran, moving planes and bombers, B-52s, to Diego Garcia, moving a strike carrier group to overlap with another one's presence in the region, and now we're moving one of our THAAD systems and Patriot battery systems out of Asia into the Middle East. This is a buildup that's happening.
Yeah.
I'm gonna.
You're saying Trump's going to bomb Iran?
I think that
Possible.
Israel is going to bomb Iran, just like Israel in the 1980s bombed the Osirak reactor when Saddam was still ruling Iraq. They just went in overnight and just completely wiped out Iraq's nuclear weapons development facilities. And obviously lots of hand-wringing, blah, 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 but it was done with the U.S.'s blessing. I think that's a very credible threat on the table.
Absolutely. And one thing to keep in mind, all of those shenanigans last year where Iran shoots some missiles and Israel shoots some missiles, the Iranian ones didn't really do anything in the grand scheme of things. The Israeli strikes significantly deteriorated Iran's air defenses. If there were a window to say, we're going to launch these strikes and Iranian defenses are not up to snuff to repel it, this is the weakest they've been in a decade plus. So very credible to think that this might be something that has some sort of legs onto it, especially since the posturing politically in Israel seems to be to extend broader and to do more, not less, interestingly. All of a sudden, there's strikes in Syria. All of a sudden, there's strikes elsewhere. It's almost as if, and The Economist made this point, I thought, very eloquently. They said, before, Israel had the U.S. to come and tell them when to stop fighting, when the battle is won and you can settle back. We don't have that here. So this could be, they might just decide, you know what, we're going to get it while the getting is good. And if that means overextension, we'll worry about that later. But I think you're right. I think very credible to think that they might opt to escalate.
Along those lines, I would look at a company that today came out unscathed throughout all this. If you don't want to play in the crude oil pool, Lockheed Martin has a 91.6 IVR. It was up by 0.42% today. Again, a survivor on a very bad day in this market. Recent swing lows coming near 420. If you wanted to bracket that, like a 400, 425 short put spread, or tighten up the strikes a little bit, you could look at something that's going to give you like a 2.5 to 1 risk to reward with a probability of profit of somewhere in the 60s or 70%. But I think that's the game plan for tonight, folks. You know, if you're going through your watch list, if you're going through your watch list and you're looking, okay, I have capital to deploy, I need to clean up a mess, make your position adjustments, right? The goal here is to not hold on to losers that are running. It's to cut them ruthlessly and then adjust, and then always adjust. As traders, we have to be willing to let go of any preconceived notions, strong convictions always held loosely, and really you don't hold them that tightly whatsoever. But if it held up today, of all days, right, and it has high volatility, it's probably going to hold up if stocks do bounce back, right? Costco, for example, fits that quite well, up 0.21% today, right? Why is that the case? It was down earlier, comes back, because people are still going to have to buy stuff and survive, and companies that source their stuff domestically are going to have an edge over their competitors. We have to think differently. This is a different market. There's a regime change going on. Do the tariffs stay? Do they not stay? I don't know. Could they do lasting damage? Perhaps. Could they lead to great success? Maybe. I don't think so, given global history. But this is a crisis market environment right now.
Yeah, I mean, to your point, you can have all these high-minded conversations about the long-term economic consequences, but that's hardly the objective as a trader. As a trader, you have to trade the price action in front of you. And just like I would concede repeatedly last year saying, I have all these reasons to be short, I'm going to nibble when it looks like it might be time. But the moment the market proves me wrong and the price action says no, I'm not going to sit there and go, no, but I'm right though. I'm going to run away. I'm going to do it with verticals to keep my risk contained, because I am not going to roll the dice on an idea when the market is telling me, back it up, this is the wrong time. It applies exactly the same way in reverse. The market is setting lower lows and lower highs. This is not the time to be a hero.
Dylan, final thought as we close out overtime for this Thursday and this week.
Don't overthink it. Get long the recession and tie up your horses, because it's going to be a bumpy ride.
Mm-hmm.
Mm-hmm. Well, we'll be here tomorrow, of course. Ilya will be back in about 30 seconds. But overtime is done for today and this week. We'll see everyone shortly on Macro Money. So for Ilya Spivak, Dylan Radigan, I've been Chris Vecchio. Good luck trading. Hope today was not terrible. See you tomorrow.
Liberation Day has come and gone, and it seems like the net impact so far has been to liberate stock indexes from some of their lofty valuations. It is an absolute bloodbath out here on Wall Street and across the broader markets. And of course, what we are going to try to unpack here is what comes next and how this develops with still more heavy-duty event risk on the calendar. This is Macro Money. I'm Ilya Spivak, head of Global Macro here on Tasty Live. And we're going to try to see if we can't make sense of how this progresses. We'll start, of course, with a look at what has occurred here, why it occurred, then see if everybody's favorite savior, Fed Chair Jerome Powell, can talk the markets out of outright pandemonium. Here is the stock market. Needless to say, it does not look great. The S&P 500 craters, and this is not unlike things we are seeing in other indexes. The NASDAQ looks very similar to this. These are both indices that are recording the lowest levels in 6 months, essentially back to September here. And if we look at the Russell, the small cap index, that's down to the lowest in a year. The flip side there, we have on the bonds a rally, as one might expect. It's concentrated at the short end. This, of course, the long end, and we can see that we're still scraping around the highs, but clearly back into a rapid advance here. And the story is, as we've described it a lot here on Macro Money, the sort of implementation of the new U.S. administration's trade policy and the effect that it's having, the chilling influence it's having on economic activity. And just to quickly catch up on the logic here, consider that the president has talked about using tariffs extensively on the campaign trail, going into the election, and of course after. So if the markets were afraid of tariffs as such, we would be seeing this pandemonium much earlier. We would be over here in November looking for it. That was clearly not the case. The pandemonium starts here, middle to late February. This is the first big sell-off. Then, of course, we get a little bit of a correction, and then the sell-off has clearly resumed and is now setting lower lows. This is very much a market that is, by definition, a trend lower, the same way this was, by definition, a trend higher. Higher highs, higher lows, lower highs, lower lows. And ostensibly, the reason that this begins where it does, the reason that stocks wait until February here to really make a move is it's not about the tariffs for tariff's sake. It's about how they're being rolled out and the uncertainty therein. And you really get a sense of what that is when you look at the GDP now forecast or nowcast from the Atlanta Fed. And it's not really the level that you're looking at here. The level is ultimately secondary. It's still quite some time before first quarter GDP numbers are published. The idea that we're looking at a 2 to 3% decline, or let's say a 1 to 3% decline somewhere in here, that's still very much open for debate. But that's hardly the point. This is a nowcast that is updated multiple times a week, usually. Anytime you get a big piece of economic data, sometimes it's updated daily if that data is coming at a faster cadence. What this tells you is the tone of that data and the extent to which the real economy is actually suffering around this uncertainty. So what you're seeing here is, of course, the woeful PMI numbers, the scary consumer confidence numbers, on and on and on and on and on. And the sum total is, it's not that the tariffs are philosophically good or philosophically bad. It's not that economic theory on them is right or it's wrong. It's not that the president is incorrect or correct in implementing them this or that way. It's that the way that the tariffs have been getting rolled out, for whatever reason you wish to construct, is having a real dampening effect on economic activity, and real economic data is telling you that the economy has significantly suffered as a consequence. Why was this Liberation Day announcement then so damaging? Well, what we got was this schedule of tariffs. And never mind what the rates are. The reality is that there are these rates bilaterally for a whole host of countries. And what this then sounds like in its inherent construction, and the market sold off overnight as soon as they heard this, is that there is a baseline tariff rate of 10%. And if the markets had it left just there, they probably would be up today, because that would imbue them with certainty. Companies would know how to adjust investing decisions, hiring decisions, supply chain arrangements. But no, what we have here are individual tariff rates that are ostensibly an opening bid on bilateral negotiations, country by country. Moreover, these rates are done by executive order, which first of all means that Congress could overturn this entire situation. And in fact, they've started doing that piecemeal. There was already action done to reverse some of the tariffs on Canada. Moreover, whoever the next executive is could just, by executive order, cancel them. And if you are a business that needs to make the plans that you need to, let's say, reshore manufacturing, because now there's a heavy tariff on Asia and not one on South America, broadly speaking. We'll notice there's a lot of preference here for South America. They only see the 10% base tariff for the most part, whereas China and Southeast Asia and Asia more broadly sees larger tariffs. So there seems to be a thread here to move manufacturing both onshore and closer, so to near shore. But if you're going to do that, that's a long-term process that takes years. Are you going to have the certainty to do that if the next executive can simply say, I don't like it, and cancel it? Well, maybe not. How long will these negotiations take bilaterally? A long time, most likely. Some months at least. Do you then have certainty with what the regime is going to be to make all those business decisions that you need to make? Probably not. And so if the problem here wasn't tariffs per se, but it was uncertainty about them, well, then the way that these reciprocal tariffs have been rolled out, and we can see this in the market reaction clearly here, it only exacerbates that uncertainty and the fog with which businesses and consumers have to operate. We see that in spades in the ISM service sector data that we see updated today. We now have both manufacturing and services. Service sector in the U.S., of course, the absolute critical engine, not just of U.S. growth, but of global growth. Really from the middle of last year, as we've talked about quite a lot here on the show, the situation in the global economy has been that the three major engines of growth, the U.S., the Eurozone, and China, have given us incredibly lopsided results, where China has been stuck in a deflationary slump since before exiting COVID restrictions, and none of their stimulus appears to be helping. The Eurozone has been in shallow recessions on and off over the past year or two. They're anemic. And the only bit in the U.S. that's been growing and growing quickly has been the service sector, largely powered by domestic demand. In fact, this is why U.S. economic strength was not spilling over to the broader world last year, because most of the demand was for services, and most of that is serviced by American firms, whereas most imports are of goods. But goods was not where the demand was. And so the U.S. service sector was really the one leg of the stool holding up, without which a global recession was almost inevitable. And what we see in this ISM data is that the U.S. service sector has ground to near standstill. At 50.8, in the logic of PMIs, you're barely growing at all. 50 is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find then here is, of course, earlier in the week, we saw manufacturing contracted at a faster rate than expected. But that wasn't necessarily surprising to a terrible extent. A contraction was already in the forecast. The deviation from where the service sector was expected to be at 53 on the PMI reading is quite significant, where the difference is down to 50.8, which is only a hair above 50 and barely enough growth to avoid total stoppage. Moreover, if we look at the details of the report, we can see very troubling things indeed. New orders growth basically stalled, right down to 50. Employment shrinking rapidly. Here, we're in contraction territory at the fastest rate since the beginning of last year. Meanwhile, the price structure still very much points to rapid rise in input costs. And of course, when earlier in the week, we were taking a look at the manufacturing side of this equation. This is ostensibly where the tariffs hit the most directly because, of course, tariffs primarily are aimed at the goods side of the ledger, since, again, this is what the U.S. tends to be an importer of. If we take a look at what's going on there, of course, the cost structure is even more ominous. But here, too, new orders are outright contracting, as is employment. And so the damage to the economy is quite real, even though the tariffs are just being implemented, though, of course, the tariffs already in place already exceed those that were set up in the entirety of the first Trump administration, and that's before these reciprocal tariffs are announced. Now, from the market's perspective, it seems clear that the administration is impervious to market discipline, at least for now. The soundbite from Commerce Secretary Howard Lutnick was that the stock market sell-off is a problem for the Max 7, not a problem for MAGA. I think that sort of captures the mood in the administration. And so from the market's perspective, then, where to look for a release valve is in monetary policy. Not unlike what happened in the wake of the 2008 financial crisis, where in the U.S. you had this protracted fight over government spending, and there was really no big fiscal impulse. And so monetary policy had to go through all of these rounds of QE because that's what was the relief of last resort. And the markets are seemingly thinking that's what's going to happen here. We have, at this point, added almost a full rate cut to the overall Fed outlook. We can see, of course, most recently the Fed updated its summary of economic projections and endorsed the view they had back in December, where they're looking for 50 basis points this year from 4.4 to 3.9, and then 50 basis points next year from 3.9 to 3.4. That's a total of 100 basis points, or 1 percentage point in cuts. The markets are already north of that in terms of the cut tally. We're out to 119, so we're already out to 5 cuts, and pretty much 6 basis points shy. And as we can see, most of them are very much focused on this year, almost a full 1% in cuts already on the menu for this year, but certainly 3 of them already priced in, and then 1 with an option for more on the menu for next year. If we look at the path for this year, we can see the first cut already almost priced in for June, second one in September, third one by December, and of course, in that we are in excess of 75 basis points here, there's room for dovish surprise in all of this, which of course now points the spotlight directly on the U.S. jobs report. Expectations here are the economy added 128,000 jobs, while the unemployment rate went up to 4.2%. The markets ostensibly would be happy with weaker numbers, if only it meant that the sweet, sweet relief of rate cuts would be closer at hand. But whether it is or it isn't, we'll get an almost instant clarification, because a mere handful of hours, 3 hours, after this data comes out, and whatever comes out in it, Chair Powell is due to speak on the economic outlook. It's the second month in a row now that he is there to speak directly after the jobs report, almost as if this is a press conference after a policy announcement. It is already, by the way, interesting that the Fed feels the need to comment on critical market moving data on the day of, to let the markets know how to interpret this through the Fed's lens. It sort of speaks to how tenuous the environment is. Typically, the Fed doesn't like to immediately jump into the speculative muck by commenting on the data as it's occurring, but clearly they feel the need to make themselves heard and guide the market's thinking. So we're going to get this data, and if we look at the way that U.S. economic data has been performing relative to forecasts, we can see that it's narrowly tended toward disappointment. When you're below zero on this Citigroup Economic Surprise Index, it tells you that economic data is tending to underperform relative to consensus expectations. And that's usually because there's been some sort of turn in the economy, but analysts' models have not caught up with that turn and need to adjust. And so until we get that adjustment and this thing moves back higher, because there's been a realignment of forecasting and reality, the forecasting still runs the risk of undershooting whatever is actually occurring. And so you have this space then here for downside surprises. But whether a downside surprise on this data will really be impactful or not probably has to do with what Powell says. Now, in the wake of the last FOMC announcement on the 19th of March, Powell said, we see the consternation, we see the warning signs in survey data, or quote-unquote soft data, like ISM, like the S&P Global PMIs, like the University of Michigan Consumer Confidence data, which has cratered as inflation expectations have jumped. But from the Fed's perspective, this could be episodic sentiment and not something that's long-lasting necessarily. What the Fed wanted to see, according to Powell, was the consternation show up in hard data, and NFP, of course, is high at the top of the hard data list. And so we might get this number to disappoint, but whether the Fed takes that as a reason to feel a sense of urgency is really what is necessary here. And if Powell comes out and says, well, yes, there's a lot of consternation in the markets, but we don't want to get it wrong. We see the economy slowing as a consequence of this, or at least taking a hit, and we had this in our forecasts. You can see that the Fed downgraded expectations for growth in March, but they also increased their expectations for inflation, anticipating that adding an additional tax on imported goods will just make the price of those goods higher. At least that's been the historical example, and certainly the Fed isn't wrong to cite it. We see the same thing in the ISMs. the price growth component is not falling off in services, and it's running away to the upside in manufacturing for obvious reasons. And so if the Fed then decides, in Powell's telling, to sit on its hands and let the balance of risks work its way out to where it's unmistakable that they can put inflation in the back of their mind and fight the growth and employment fight, that if the Fed is still inclined to wait and see how things shake out, well, then the market doesn't get its white knight. And if that is how this ultimately goes, then seems to be a lot more selling of stocks to be done and a lot more future easing to price into the long end of the curve, as the market reckons the Fed is going to have to play catch up, and quickly, if it delays for much longer. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, as I am every Friday. I'm also there on Mondays, on with Victor Jones for The Price of Truth on Tuesdays, also on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for watching. If you're doing so on YouTube, like and subscribe. Good luck out there. Macro Money's back next week.
What is going on, everybody, and welcome back after an extremely volatile market after hours yesterday. We got some things to get into, but before we do that, Gus, how are we doing, brother? We're holding up?
Yeah, holding up is about how I would put it. It was a rough day for me today, rough day for everybody, but I'm just doing what I did last time. I thought we found the bottom and picking up some shares, and just gonna wait it out. Playing pretty risk averse, but I'm just choosing to view this as a discount, and sometimes you gotta take one on the chin. That's what happened today. I think what differentiates good traders from great traders is your ability to tolerate losses, especially in times of market-wide downturn. I mean, it's like, think about what makes somebody a badass. Like when you think about a badass trader, what makes them that way? It's that they're like, I lost 20K, whatever, I'll get it back. 20K this morning, nothing to a guy like me. So that's what I'm trying to do. I'm crying internally though. It's a mixed bag.
It's like that meme. It's that meme, but it really is being able to be calm and make thoughtful decisions through chaos, especially during now. I think a 1,500 point move to the downside in an hour was one of the quickest moves to the downside I think I've ever seen. From the last years, I remember watching March of 2020 a little bit. I know that happened very quickly. The recovery was even quicker, but 1,500 points in just an hour is pretty crazy. But I'm glad everybody else is holding up with us.
I was thinking we were going to get a circuit breaker like this morning. I was like, all right, are we going to have to halt this thing? But fortunately we didn't get that far.
We even made lower lows today. Just as a cherry on top. So I know tomorrow we have NFP, some type those binary events, which will bring more volatility to the market. So I'm interested to see where volatility is going to be. I know yesterday Dr. Jim was making a joke. Watch VIX open up like 0.47% after the move today. And I thought that was